Good morning. Welcome to Monday, the 22nd of October, Trade Live with IG, with myself and Ronnie Agnig. No, it's not, because he forgot he was on this morning.
How do you forget you're on? It's hopeless.
Chris Beecham parachuted in at the last minute.
Very last minute, 23 minutes past 7, I think it was.
Didn't even get a chance to brush your hair.
No, I know. Not since I left the house, anyway. It's very windy this morning.
Really?
It was where I was.
Didn't feel that. Must be nice to live in the countryside.
Yes. Well, apart from the darkness and the... Yeah.
It was depressing this morning, wasn't it? Welcome to winter, everybody.
It felt very wintry this morning.
Yeah.
Sorry.
Right, our traditional weather report from Chris Beecham when he arrives in the morning. You and Aaron are hilarious. First thing in the morning. Oh, what did you think of the rain over the weekend? What did you do at the weekend, Chris Beecham?
What did we do? We bought some plants for the garden. That was nice.
Hope they haven't been blown away.
No, exactly. We've tied them down, I think. So new apple tree, new pear tree, that kind of thing. Party as well. A little gathering on Saturday at somebody at some friend's house. I know. Socialising. New year, new start, and all that.
A rave in the countryside.
Not quite a rave. No, drinks, gentle drinks at a friend's house. So
nice.
Yeah, very nice. You?
Any board games?
No board games.
Right, we're what we're seeing then. Well, one thing we got to go over quickly is the Fantasy Football League. Now, Chris, you're not involved in this. Ronnie would be, so I could. But let's get this this up. Can't doesn't seem to be able to. There we go. Right. So we've got Julian at the top. Well done, Julian. Absolutely smashing it. Mark Lamb, Monkey Man is in third place. So Monkey Man has 298 points, but he left 26 points on the bench this week. If there was ever a week to have your bench boost in, Monkey, what happened there? So you're 6 points off the lead. That would, of course, you could say, oh, well, but obviously if you substitute people in, well, no, because he had Sanchez, who was -3. So his goalkeeper even would have given them a 7.
I'm just going to nod sagely at this point because I have no idea what he's doing.
Down the league, there's Dave. Gav Ackers is there in 7th. We've got Ronnie there in 10th. Myself in 12th. Strong mid-table performance. Dan Gummer, Neil there. Aaron Bright in 16th. Oh, the portfolio master. What's going on there? We got Luke Moore, Aaron Bright. Producer Phil in 18th. Ida Rock, come on, sir. You can do better than that. And Steve Davies, I think, has stopped playing, has he? Right. So what have we got to look at this morning? What is coming up on today's show, people? This Monday, 22nd October, you've got myself. Well, it's going to say the wrong thing, isn't it? Yeah, it's going to say Ronnie.
You can't blame them for that, can you, really?
So, yeah, and then, oh my goodness, you're on at 8:35 as well.
I think producer Phil's promised to swap that one out for me, but...
Yeah, good luck.
He's not having a fun start to the week, so we'll give him some space.
Well, it serves him right. I said to him yesterday, does Ronnie know he's on tomorrow?
Ronnie did know, until he forgot.
Right, next page there. Then we've got all sessions opening bell. Now, of course, MicroStrategy already trading down 3.8% because Bitcoin is coming off.
Yeah, it's a sort of Sunday night weakness in Bitcoin, isn't it? Sort of often comes. So it's now, if you make yourself a hostage to Bitcoin, like MicroStrategy has, or strategy, as we should call it.
A hostage, a prisoner. 10 past 9 is Commodity Corner with John Mayer. And then we've got the one, the only, Axel Rudolph, our trade of the week.
I wonder what he's going to do.
How's he been doing recently, Chris?
Reasonably well, I think. The last weeks I've not been checking up on him. I think he's doing all right this year.
Yeah.
I think
good.
We were certainly up for the year the last time I checked. Comfortably up for the year, should I say.
Good stuff. Right. We've got, we're now hearing Terence and Phil in the studio. Okay, what have you got to listen to? Well, my Sunday was a very enjoyable listen to my second favourite podcasts.
Why, what's your favourite podcast?
Obviously, The Art of Investing, Chris Beecham. My second favourite podcast, Compound and Friends. If we can get that up on screen, you'll see it's Tom Sosnoff. There he is. He is on this week. Compound and Friends. Tom Sosnoff will teach you trading. It is bloody wonderful. I spent an hour and a half listening to that yesterday. And there is the picture of him with Josh Brown. Of course, the funniest thing is, of course, Josh Brown rose to fame on CNBC.
Yeah.
Sosnoff just comes out and goes, yeah, the reason I started tastylive was because I didn't like CNBC. Yeah. And he says it to him. And Josh Brown says, I think we can cut that bit out, can't we? But of course they didn't. So, yeah, great episode there. Highly recommend it. And, yeah, Sosnoff. Really, what's it called?
Unvarnished?
No, not unvarnished.
Unfiltered?
Unfiltered. Sosnoff Unfiltered there. So a good one. Let's do it. Right, let's go into some overnight action. So let's start off with what is in the week ahead. Now, a wonderful publication comes out every Sunday called The Week Ahead by Chris Beecham with his insight. So let's take a look at that, Chris. Do you want to give
You're always just nice about it when I'm not in the room as well, or you're only nice about it when I'm in the room?
I'm nice about it every Monday.
Okay. Oh, when I'm usually in the room, so it's fair enough. Yes, it's a bit of a funny week, isn't it? Because you had all the excitement last week of the Fed, and not the will they, won't they, but how far would they go?
Yeah.
And they do deliver their rate cut. And now things slightly ease off, don't they, in terms of data? You've got PMIs tomorrow. That's perhaps Monday starts on a slightly cooler note because you've got Chicago Fed and consumer confidence in the Eurozone.
Yeah.
Nothing rock star, is it? Then Tuesday, flash PMIs. That's the key one, I think, to keep an eye on. If I can get mine to work.
Until Friday.
And then Friday, why? Because it's PCE day.
PCE day.
Ange is well versed in my dislike of the PCE data and why nobody cares. Because you had CPI earlier in the month and you've had the Fed cut. Unless it's an absolute shocker of a number, unless this is the first.
What would be a shocker? So they expect it's 2.8.
Yes, and 0.3% rise month on month. I think is the core they're expecting it to rise by. So unless that massively beats expectations, it really is a bit of a non-event at the end of the month. And the fact we have to sort of pay lip service to it every month, I find quite tedious.
Are we bothered at all by 0.3% month on month? Because that's what we had in the CPI as well.
Yeah.
Well, not if you're Stephen Mirren.
No.
Stephen Mirren.
Stephen, I'd like to vote for 100 basis points of cuts at every meeting.
Yeah, negative interest rates.
The FT described him as the child in the playground that nobody wants to play with.
I mean, he looks like that.
He does look a bit like that.
Yeah.
It's a bit odd. And it was interesting because his was the one sort of dot plot really out of place. Everyone else didn't really go for massive cuts, did they?
Yeah. He was asked in an interview over the weekend, do you think tariffs have impacted inflation?
And what did he say?
Take a wild guess. Not at all. I mean, don't lie. Don't, if you're gonna, we know the White House is full of shit, right? Mm-hmm. So if you're going to infiltrate the Federal Reserve, at least have some dignity to give some kind of balance in your answer rather than a blatant lie. And just the White House. But
there's no room for that in that administration. There's no room for disloyalty. He knows they would turn around and get rid of him if he deviates from the party line. So he has to stick with it. So you have this sort of theatre going on where they pretend that it's not about inflation and the Fed and Powell pretends to care what Trump thinks.
Is there a limit to that? The just flat out.
Yeah.
I don't, what do you even call it?
When do people? Yeah, the posh word is mendaciousness or mendacity, isn't it? That you can go on and say this stuff, almost knowing it's not true. At what point? And I suppose maybe we asked this since 2016. At what point does somebody finally say enough? And we haven't reached that point yet.
And who will say enough? Will it be China and a group of new allies? Will it be the bond vigilantes? or, you know,
the electorate at this rate, because of the midterms they come next year. That could be interesting if they lose quite a few seats, because they're not polling massively well.
38%
Yeah.
for Trump now.
Yeah, so it's becoming quite unpopular, and the risk is that they lose a few, and that tilts things back again. Yes, obviously the US-China thing has really taken quite a back seat, hasn't it? It's rumbled along, but it's not been the major driver of activity that people thought it might be.
Yeah, it seems India's definitely in the targets now. So that leads us to our first story of the morning, which is Trump's H-1B visa fee to hit US employers with a $14 billion annual bill. And this is $100,000 to highly skilled workers who are now coming in to the US. Now, 71% of those workers come from India, 11% come from China, and around 17% from other countries. So it's very, very focused on India. And in fact, the Indian tech stocks are down 2 to 3% on the back of this.
They keep trying to drive India away. I don't understand the logic behind this.
Well, they are supporting Russia.
Yes, and I suppose the logic from where Trump sits behind the desk, that if you can detach them, but surely you detach them by sweet talking them and
Diplomacy.
Diplomacy and trying to bring them around to the benefits of being on the US side of things rather than the Russian side of things.
Yeah.
Sell them US oil at a discount. I don't know. Do something, but to tilt the largest, the most populous country in the world, and one of the becoming nations of the next 100 years, so decisively into the Chinese-Russian camp.
Yeah.
It seems to have happened. The fact that Modi and Xi got on and chatted away is a real own goal for US policy, I think. You don't have to be an expert in geostrategy to talk about that, I think.
I hadn't actually noticed this. What is that?
Oh, isn't it?
Is that a joke by the
No, I think
Times,
it's very much a real thing.
Oh my days.
That's how policy is made in the White House at the moment.
Oh, dear me. But one good thing has come of it. We have explored, we being the UK, to consider dropping visa fees for the top global talent. So we're going to steal them away.
Well, you'd hope so. I didn't realise the Treasury could move that quickly over a weekend, but maybe.
Impressive.
A rare moment of sanity from the UK government.
Number 10 in the Treasury are discussing their proposals before Trump said he would increase
Oh, there you go. That's good. That's the kind of thing that sort of lifts us away from the US a bit. That's good.
Right, front page of Financial Times. Not too much there, to be honest. How can hedge funds pay traders 100 million? The good old days. I must say, sitting in a room with those guys for the 3 years I was there, you would have no idea what they're getting paid. No. Absolutely no idea. You know, a guy worth $1 billion or more sitting 2 rows away from me. So ordinary.
Yeah.
Not in skill terms, of course, intelligence and everything, but in terms of the way that they act, the you know, see him making a cup of tea. It's just like walking over there and seeing yourself and Axel work.
How do you know I'm not with me?
But yes, the article there. Retail and hospitality chains sound alarm over UK jobs market. Do you want to even click on that? It's more of the same.
More depression, isn't it? Really?
Yeah.
More poor.
We won't look at that. And then UK government approving a second runway at Gatwick as a Gatwick bondholder. I'll be very relieved. And then, yes, the Murdochs, Michael Dell and Oracle are buying TikTok. So the conglomerate that is buying TikTok US is going to be Dell, Oracle, and Fox. So it's the Murdoch empire is going to own it through Fox. So of course a well done from Trump for all that support. And that's going to be concluded at some point this week. So you can see Oracle shares now trading 312 on the back of that. That's up 5%, but we can't really tell. Oh, market's come off a little bit. We can't really. Wow, Gold is going through the roof.
There she goes.
Wow. 3,716. Is this the final move higher for gold, the blow off top?
The final move higher.
I think I'm of the view now it has to give some back.
Yeah.
I think it's going to 4,000. In fact, I think it's going to 5,000. But is this too much too soon, or is this the inverse of Trump?
Yeah, because it's interesting how you essentially had gold going sideways from mid-April until the end of August. And it's that kind of coiled spring effect, isn't it? Once it finally breaks the upside.
Incredible consolidation.
Yeah, it really goes. So that's your kind of payoff. And this is where the patience element comes through in trading and investing. If you can sit through the tedium of watching it bounce up and down for 4 months.
Yeah.
And then finally it delivers the goods. And this is sometimes you have to hang with this stuff to let it run.
Is there anything else doing that at the moment, the FTSE?
You must talk about the FTSE, I suppose. Nice 200. Record highs abound for stock markets. It's
Save our stock market.
well, yes, and the month in which both the Dow and the Nikkei crossed 46,000. It's quite something, really.
Asia moves overnight. Nikkei is up 1%, going well there. The Hong Kong Hang Seng is down 1%, so a little bit move lower. Shall we have a look at the Nikkei and just
Yeah, we could do those two.
revel in its wonder? Let's do the daily chart on that and see where we're at. Look at that move.
Absolute barnstormer.
There are alternatives to the Nasdaq and the Mag 7.
Yep. It's come actually storming back from April and the doom that you had there. And again, this is, you've seen it, haven't you? How it rallies, it spikes, it comes off. Yeah, 50% move. It's quite mad, isn't it? But it had a very miserable, when was it? Was it July and August? No, mid-August was really tough. 2,000 points down, trying to buy the dip in it, and then off it goes again. So really impressive performance there.
Yeah, really good.
But when is the last time we saw an index gain 50% in
6 months?
6 months? An index of an entire company's nation stock market.
I mean, Buffett was telling you this 12 months beforehand. He was saying, I'm going into Japanese banks and I'm going to continue to build positions. And that was when Munger was still alive, so it must have been 2 years ago.
Yeah, exactly. It's incredible how you've had two massive dips to about 32,000 within the space of about a year.
Yeah.
As well. So it's not been the easiest. It's certainly not been the quietest trend in the world, has it? Yeah. Really?
That's a great question from Matteo Di Napoli. Is the second runway approved at Gatwick a positive story for EasyJet?
Well, I suppose for airlines generally, yeah.
Yeah. No, I like the thinking there. I mean, I don't know when it comes. Generally, it's about 17 years in the UK to build anything like that.
Yeah, exactly. I don't know what it says in the article.
It's just tarmac. I mean, come on. How long from Terminal 5 being agreed to until it was built, do you think? That's one for ChatGPT in the break. Andrew McKelvey saying yes until they put the landing fees up. That's fair. But yeah, of course, there will be a lot of new slots available at Gatwick there, which is our assets to the airlines. So
possibility of a fifth terminal at Heathrow emerged as early as 1982, and then formally announced its proposal for construction in May 1992.
Really?
Yes.
So I wasn't far off with 17 years.
The public inquiry sat for nearly 4 years around it. So there you go. Didn't begin construction until 2002.
Okay, so I'm not sure EasyJet's a buy today on the back of that then.
Maybe next week.
Okay, we've done a week ahead. We've got to look at company announcements. Do you want to go through those, Mr.
It's a slightly busier week. I have to say, it seems to have been a very slow start to September for company announcements.
Yeah.
A bit busier. Raspberry Pi, most notably there, and then interesting because you had a shocker from Next last week on the retail front.
Wasn't it?
Very, very nasty pullback in the shares, although they've done very well the last few months. And so you've got retailers in the shape of Kingfisher and JD Sports, so different sectors, obviously, but those two that we can watch for further signs of how the UK consumer is faring. And then also Halma and Pennon, which is water. And then just a couple in the US, Micron and Target, really. So still September, not been the busiest month for company news, or at least not scheduled company news, because you've had Intel, didn't you, last week? Again,
Yes,
30% in a
and
day.
Oracle as well.
And Oracle.
So we've got ex-dividends. You get paid from Rightmove. Didn't even know Rightmove paid a dividend.
Yeah.
Phoenix and Endeavour Mining and Drax. Drax
Of course, yeah.
used to be a nice chunky dividend.
Well, Phoenix is quite chunky, isn't it? It's an insurer, so I think you do quite well out of
Right.
Phoenix in terms of its dividend.
Good. From the flames. Let's have a look at the front page of the Times. Now, I don't like this guy already, because this article is all about how London's out of the question for it. He's built a company that derives 100% of its revenues in the US, right? It's a British company. He's from Sheffield. He's grown it to be worth $1 billion, and he's front page of the business section just moaning about London and its prospects. I mean, this is the kind of person that should be backing the LSE and should be, working to see what he can do to float his company. But all he wants to do is come on and beat it up. So, yeah, the
What does he do?
company's called Clio. They are, I read it this morning. Should we have a look? AI
financial assistant, according to the Times. Which
financial assistant.
leaves me none the wiser, particularly. But
Yes.
but then, if you've got all your revenues in the US,
Exactly.
Why?
It's almost he just wanted the article by the looks of it.
yeah. But I suppose you are right in the sense that there's the kind of person that the government should be courting to
Exactly.
persuade them. As a startup founder, what would it take for you to list here?
Yeah.
That kind of question. You'd hope a quick chat with the Chancellor wouldn't go amiss.
Well, not a quick chat, because we see it in the White House again and again and again. He has his forums with the top business. Now, by no way is this guy a top businessman in the UK, but get people round the table that are going to drive us forward as a country, and the FTSE, But Revolut is so important.
And there it goes. Because once they go, they don't come back.
No.
You don't come back from New York, do you, really?
Yeah. But then they tried, Rachel Reeves tried to get the banking license for Revolut, and then the Bank of England said absolutely not. So
You had to have everyone working in harmony, and you're not getting
Exactly.
that at the moment.
yeah. Right. Okay, that's us. So a quick look at how the currencies are doing. Currencies and commods world. We have the pound took a little bit of a beating last week, 134.80 this morning. So it has had a small rally. You've got the yen at 148. And I tell you, one thing I did consider was shorting GBP yen, because you can't short sterling against the dollar, because the dollar is obviously one of the biggest risks out there. So
Sterling yen.
so shorting, so in other words, going long yen, short sterling, is that one to ride into the budget?
Quite possibly. Although, if you argue that, as some have begun to say tentatively, that maybe some of the pessimism is overdone, which
About
is
the
a
UK?
hard argument to make, but markets are about trying to predict the unexpected, aren't
Yeah.
they? So if you argue that maybe the markets will be more sanguine about the budget, that's, I suppose, your risk here, particularly. Obviously, sterling yen has been on a very good run since April, so you might just be standing in the way there a little bit.
Yeah, true.
But it could be the way to play it, particularly.
Good. Right, Steve Davies has the full backing of the board, he says. Absolutely, the chairman is happy. and is prepared to give him a little bit longer than week 6 of the fantasy league. But yeah, let's see how the week goes. And Boston Frank saying, I think the Nasdaq will be up today. Well, the day ends in a Y after all.
That's the exact thing I was going to say. It ends in a Y, so therefore it must be up. Because
up 2.2% last week. The S&P was up 1.5%. I'll take the other side, Boston Frank. I will say the Nasdaq will be down this week. I think that we are in line for a correction, and I'll stand by it. Not me.
Tune in next week for the same thing.
In the comments, not me is saying, not by the looks of Bitcoin. Is Bitcoin and Ethereum even more an early warning signal, the canary in the coal mine of risk appetite this week? If Ether or Ethereum down 6.6%. Bitcoin down 2.2%. We're certainly seeing those. So that has left the Nasdaq down 12 basis points in early futures. So our chart of the day is a UK stock. A UK stock that should be easier.
Okay, it narrows it down a bit. It's an obscure Japanese thing. Okay.
And is it in pence or pounds? Well, it's always in pence, but is it? The price is on the chart. Okay, is it 3 numbers or 5 numbers? It's 4 numbers. Interesting. So it's...
Okay.
Okay, right. See you after the break for the London Stock Exchange Open. Let's go to Guess the Chart.
Won't stop, he's clicking all day. Short then long then fade away. Angel smile, she's playing it cool. Says I watch the moves, let you play the fool. Dom's on comes and Cam's on shot. Terrence says cut when it's getting hot. Rich is chasing every move on screen. From BP's rise to Tesco's green. Ancient's back with a steady style. She's not in the trade, but she's watching the pilots going down. I'm yelling timber. Shot so sweet, you'll remember. Footsie dreams and UK pride. Trade live with IG's on your side. We'll ride this wave, we'll set that pace. From the city to every trade in space. Axel smiling, we've all got skin. Trade of the week is the one we're in. We play the game, we roll the dice, but please remember this is not financial advice. From Shell to Rolls and BT Lines, UK stocks, yeah, the trade's all mine. It's going down, I'm yelling timber. IG Live, you'll remember. Axel's cold, which is trades, ain't just calm. And the team keep the show in charm.
Oh, we're all stumped at that one. We are stumped at that. £13.70. To me, Glaxo was the obvious one, but that didn't make sense in the
No.
chart. You thought Smith and
I thought Smith and Nephew, but maybe the chart I'm looking at doesn't seem to match up.
Jet 2. Nothing beats that chart.
Oh, there you go.
Oh, of course, they did have the big warning, didn't they? Interesting. Right. Chris Beecham, would you like to ring the bull bell?
Oh, yes. Not too loud, though, because people complain about it.
Yeah, go on. Loud. Loud as you like.
Oh, yeah.
Wilster245, welcome to the chat, saying, is it the Smarter Web Company? We shall, do you know what, let's look at the Smarter Web Company. I hadn't planned to this morning, but we'll do that after we get the open of the London Stock Exchange. Here it is, BT Group, back down below £2. That must have had a bad Friday.
Yeah.
Oh, what's the big move in rank?
Rank.
Remind everybody what rank does, Chris Beecham.
They're casinos.
Yeah, gambling group up.
They're not
4%.
connected to the guy with the big symbol. Remember watching those films? No?
No.
Oh, I can.
Right, the other movers, Fresnillo up 4%. I'm assuming that silver's had a move.
Silver move must be. What's the silver move?
And Rio Tinto up 1.2%, £46.50 now.
New record high for silver at 43.70, 1.4% higher. So
4370. Well done, Silver Hio. Legal and General up 80 basis points, 239.90. We have I'm guessing the rest of the miners must be up. Oh dear, what's gone on there?
Legal General was
Widgets.
upgraded this morning as well, so I think that's why.
Legals has been upgraded. Where was that?
It was BNPP Exane raised to 265 pence.
Nice.
To outperform.
Right, then the smaller movers, we've got BAE Systems, £19.59. We've got, I thought I saw BHP there, BP, £4.21. Glaxo, £15. And then next, small recovery there. What about the losers, I hear you say? How are those losers doing? Well, it's IAG down 1.2%. And EasyJet down 80 basis points.
There you go. So, is it because it's going to take years? I don't know. Is it just, I don't know. Let's not try and put a reason.
What else has happened? Has the price of oil gone up? No.
Oil is up this morning, yeah.
Is
So,
it?
yeah.
Okay.
0.7% higher for US crude.
Right. Well, that'd be interesting because the algos would definitely follow that. That might be an opportunity in EasyJet. I don't know if you do think it's positive news on Gatwick there, because the algos wouldn't read that and they wouldn't put two and two together.
No.
As smart as our viewers are. There you go. Our viewers beat algos. Right, Diageo down 70 basis points, £18. It's about to go through 18.
How the mighty have fallen.
Oh dear, oh dear, oh dear.
No fizz in that one.
And then across in Europe, oh, there it goes, ASML, 8.14 from the lows. It's like on 30%. 30% from its lows a month ago.
A month ago. That's not
Wow.
bad at all, is it, really?
That's great. Rheinmetall, 1939 to 1945 is the spread in Rheinmetall. RWE, 80 basis points. That tickled you, didn't it? You like that one?
Dear.
Yeah. Oh, Porsche getting smashed. Have we had some numbers from them this morning?
Every time I come on this show, there's something that's a shocker in
Yeah,
DAX.
that's looking like a car crash.
Continental last week.
This morning.
Stop it.
That comes right from Terence. Well done, Terence.
VW warns that Porsche EV delay will put €5 billion dent in profits. That was 2 days ago, Saturday. Yeah.
Yeah, after the Germans dialed back the rollout of electric models due to
late
weak
Friday.
demand and slashed its 2025 outlook. So a profit warning from Porsche is seeing Volkswagen down as well.
Very, very depressing.
Dear. Well, this is just constant, isn't it, for these European car makers?
It's something after another, isn't it? It really doesn't stop. Bad news just keeps on rolling in here. I suppose that's why the DAX is having a bit of a miserable start to the day. Porsche,
I bet it is.
Volkswagen, Stellantis.
BMW down 1.7, Mercedes down 1.2. Europeans, it's not just Tesla that they're saying 9 to. It's all the electric cars.
And then if the Chinese make inroads, then that will make life even harder. Really?
Inroads, very good.
That wasn't
on roads.
On roads, off roads. No.
Michelin obviously down in sympathy as well.
Yeah, but electric cars need tyres. Don't they?
No, they fly. Back to the Future, such a good movie. Puma. I'm really torn in Puma because all the noise is there pointing towards a deal. So I'm going to come in one morning and it's going to be 30 euros.
Yep.
So should I just buy it? Yes, I should.
Probably.
Right, let's do it. God, it's 0.5% spread at the moment.
Nothing like a
that.
rigorous process of filtering for your trades, is there? Really?
Well, I've been thinking about it for 5 days now, and I watched it at 22.20 and said no then. So at 21.30, somebody's beat me to it. Monkey Man jumping in front of me. I won't go crazy, but I have to have something. Otherwise, if it gets bid for, I am going to be kicking
Not a happy
myself.
bunny, no.
But I'm not loving the 0.5% spread. Let's put a 21.30 limit to buy.
You're just going to sneak in there.
I'm going to try and sneak in and see if we can get mids. Right, how many do I want to buy, Chris Beecham? I want to buy 10,000 euros worth. So that is, let's put it in order. Price level 21.31 to buy 500 shares of Puma. That is going in there now. Right. Imagine not getting done. I've decided not to buy them there for the sake of 3 ticks. Imagine they get bid for the next hour and I don't get done. I'd probably stop myself getting investigated anyway for insider trading if it happened that quick. 24-hour trading, you know this is the absolute bane of my life, the fact that we show moves from... have we changed it? Yes, we've changed it. At 8 o'clock, we no longer show Friday's moves.
So that's today's.
We've changed the world, Chris Beecham.
There you go.
So that is today's fresh move. Oracle up 80 basis points. Because that was showing up 5% this morning at 312 euros.
Okay.
I'm very happy about that. And then Apple unchanged at 245.75. Do we have any losers? We've got Walt Disney. Oh, my sister messaged me yesterday. She said, God, they've lost $4 billion in market cap because they sacked that guy. Is it Jimmy Kimmel?
Jimmy Kimmel. Is that Disney?
Or
ABC?
Was it Jimmy Kimmel or was the other one? Yeah, but it's owned by Disney.
Oh, okay. Yeah, it was Jimmy Kimmel last week, yeah.
Yeah. So, yeah, 2% off the company. It's Walt Disney worth $200 billion. So it's been marked down another 60 basis points. Is my sister the sign to buy or sell? She'll be watching at home.
Nvidia is 20 times the size of Disney. Is that right then?
20 times the size of Disney. I was thinking about that coming in this morning, thinking, right, old industry versus new industry. You know, because it was, I looked at National Express, and National Express has just been absolutely dismal, hasn't it?
National Express.
Why can't the likes of a National Express make money, or a rail company in the UK, versus an Nvidia that's worth 4 trillion? What went into being worth 3 trillion last week?
Oh, Microsoft.
Google.
Google.
Worth 3 trillion. You know,
Alphabet.
why have we got companies that are worth $200 million? You know, yet we use them every day. They just don't make money. EasyJet, another example, has never really recovered from COVID.
Because it's a story, isn't it? You need the compelling story to go with it. It's not, you're not building the future, are you? As a bus company or an airline. It's hard, isn't it?
But then you think somebody is building the future, like Smarter Web Company, and that doesn't even do well. So let's have a look at this. You know, we're not just ones to sing when we win, because this has been brutal, absolutely brutal. So let's get an update the way that we used to do this on the MNAV. The MNAV now 1.3. That's down from a range of between 2.5 to about 8 when we started looking at it. And they've now got 211 million sterling of Bitcoin and cash, mostly Bitcoin now. The Bitcoin held nearly 2,500. But the share price now, I would imagine it's probably even below £1, is it? On today's SWC, 95 to £1. So what's been the problem? Well, the problem is he stopped managing to raise new money. And ever since the bond issue, he did the convertible bond and then hasn't really managed to raise any more money apart from the stock he sells each day. But now that he's selling stock at 1.3 MNAV, then you're not really getting much upside from that. So what comes next? I think he has to do a buyback. So I'd rather see almost that he sells a bit of Bitcoin and buys the stock back. Certainly doesn't sell any more stock under an MNAV of 1.7, which is where MicroStrategy used to trade. So yeah, something has to be done there. I don't think you keep on doing the same thing that's not working. And you need to show a little bit of belief in your share price and protect the shareholders now, rather than continue to dilute them at 1.3 MNAV. Doesn't make sense.
It's just an attempt to replicate strategy's success, isn't it? And it's just not going to work in the same way because it doesn't have that cachet, I think is the word I'm looking for.
In what way?
Well, because somebody's already done it, and it always feels like a bit of a cheap imitation. There's a small UK company doing this or whatever. It doesn't quite get the same way. I don't think there's not that certain groundswell of interest as well. You can argue maybe there isn't enough. Yeah,
but I mean, it's certainly not just Smarter Web. They've all been absolutely hosed. So MetaPlanet is you can see exactly the same chart there. So it's just a disbelief in the business model.
Yeah.
So that's what I'm saying. They've now got to try and sort of change the business model when you get down to an MNAV of 1.3. If it's an MNAV of 1.8, it still all works. And it's still gradually over time, suddenly you'll look one day and the company will be worth over $1 billion sterling. But at 1.3, there's no point in issuing new stock because you're only getting a 30%
bump.
Increase bump. Yeah. Right, it is 8:13. What else would you like to take a look at, Chris Beecham?
Oh, what have we got? What's moving this morning? Very little. I mean, the DAX having a bit of a nasty start to the week, has to be said, but we covered that earlier, didn't we, with them? It's interesting, if you look at the seasonality for the DAX, it always has a terrible September, very dire month, and then from October it just tends to take off, at least on average. So you're kind of clinging on, waiting for it to turn around.
I must say, I'm getting very bored of everybody talking about seasonality.
Sorry, I was talking about it before it was cool, thank you.
Yeah, no, you get let off.
Banging in the drum on it, but yes, when everybody starts talking about it, it makes you go, oh.
Because it's irrelevant. It's completely irrelevant.
I don't think it is.
There's no Trump in seasonality. There's no gold going 3010 in seasonality. There's no weather. That's the only thing that's seasonal, is the bloody weather. Stock markets are not seasonal.
Well, they very much are. Historically,
but that doesn't mean they'll be this year.
No, this is what I always say when I talk about seasonality to people. When I introduce clients to it. My favourite bugbear, I'm going to bore you for 20 minutes now on seasonality, but it's like weather and climate. In the winter, you expect it to be cold, but it doesn't guarantee that it will snow. But seasonality says at this time of year, it can do this. This is what historically it has done. So when we say, oh, well, it often comes off in September. So if you see an index drop a couple of percent or 2 or 3 or 4 or 5%, that's not a surprise. It often does that. For whatever, the reason's irrelevant.
Yeah, but you need a reason.
Well, yeah, but it's simply saying, oh, it's not to be unexpected. Whereas it teaches you, therefore, that Q4 is often very strong. And what's interesting, of course, is when it doesn't happen. And so it does not always match the expectation, but it is nonetheless something that I think is just useful to keep in mind. It's, this time of year, it tends to do this.
I'll give you the stupidest example I've ever seen, right? And this was in 1999. And it happened for about 4 years. Oakley sunglasses was listed in the US. And Oakley used to go up in March when we were getting towards spring and summer in the Northern Hemisphere, because they sold sunglasses.
More. Yeah.
And I'm like, well, surely you just buy in February and then you sell in August.
Yeah.
And it worked for 3 years, and then gradually it stops working. Now, seasonality, it's all arbed out now because the AI knows it. So it doesn't happen anymore.
So, but if it still goes up in Q4, which is what it's supposed to do, or it does on average, is that still not seasonality?
There wasn't a Santa rally last year.
Well, no, it's not a requirement that it has to happen. And when we always talk about seasonality, when there are other guys on Twitter and stuff that will do these sort of tables of, when it rains on the second Tuesday of September, and it's what happens next in markets. When Peter Mandelson gets sacked, what does FTSE do next? Because that's happened enough times for us to use the data set now. It's still a small data set. If you're a statistician, you'd be saying, well, there's only 40 or 50 data points in that. That's not enough, and that's fair enough. But it's still nonetheless, you can say, this does tend to happen.
Do you think that it gives a higher probability of a market going up or down? Or is it 50-50 on any?
I think it was Goldman's that said the probability the market goes up on any given day is about 66% over history.
Yeah.
And if you look, of course...
But I would say the probability of the market going down in the next month is 80%.
Why?
Because it's so high.
It's gone up.
Because it's gone up so much.
It's gone up a lot. Therefore, it must go down.
I think we're heading for a correction. I took big action today, this morning. As soon as I woke up this morning, I thought, I'm out. And I have certain levels. I have got my trading account, which is obviously in and out, in and out. I've got my SIP and ISA that I trade on a long-term basis. And then I have my pension that I don't touch. And that's with St. James's, so I cannot touch it.
Right.
I sent them an email this morning to tell them to sell everything and go to 100% cash.
Right.
So I do not want this market to move for another 8 hours, because that's how long it takes St. James's Place to enact.
Now, if you look at the
I'm
Nasdaq,
done.
we're up sort of 1,700 points, aren't we? We were down at below 23,000 at the beginning of August. So we've come a long way. We had was it 10 days of winning last week, wasn't it? Over the last
10 days of winning in a week.
10 days of winnings in the gains, 10 days consecutive moves higher, wasn't it? I think it was.
And it's 3 weeks in a row we've been higher. That is what I'm selling.
Yeah.
I bought it here and I'm selling it there today. And I'm out. I am happy to be in cash. I'm not a greedy man. I will sit there and take my 3.5% in money market funds.
Okay.
Because this is insane.
But you've been saying that for weeks.
It has been insane for weeks. And what happens in a correction, Chris Beecham? It drops 20%, which is down to here. Now that is the level it should be, around about 21,000.
Technical correction is 10%, isn't it?
So then that takes us to here. Yeah, I would accept that. But this last bit here is greed, and it's ridiculous blind optimism, and it's people not knowing what they're doing, and it's people chasing the market. So that's enough for me. I'm out.
So I think it's fair to say you're not a fan of the rally. So yeah.
That's not a rally.
What is it then?
A rally is this
Call
bit.
it a bubble.
It is a bubble.
Oh, you know what the definition of bubble is, don't you? Something that goes up that you're not in.
I thought you could say. Or. No, I'm
That
not
was
gonna
so
go
funny.
there.
I heard Ange laugh in the studio.
Yeah, I heard Ange as well.
I hope she-
Right, Ange wants in here. So we're going to be taking a quick break, and Ange is going to come in, and then we're going to keep Chris here prisoner for a little bit longer.
Can't leave, can I? So I shouldn't ever say yes to producer Phil on a Monday morning.
Good stuff. Right, see you in a couple of minutes. If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves. Welcome to the Art of Investing, a brand new podcast to help you achieve your investing goals. Join me, Rich McDonald, and my co-hosts, Mark Spice Holden and Chris CJ Fellingham, every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience.
Hey, welcome back to Fast Markets, where it's so fast you don't see us swap seats. Thank you very much for...
Why do I have to move?
Because this is the Ange's seat. I've got the configurations together. All my screens are working.
This is the era of hot desking. You just sit where you can.
Efficiency grows as you build your, but Phil says my screens make his eyes bleed, but because I have them in a certain order, everything just works the moment I plug in. So yes, very, very good morning to all of you. In fact, it's working so well that our screen there is not showing the chat, which is fine because
I can see it. But...
Yes, but that's not working, but it's fine because with all my screens here, I can see it here. Bigger Beers, good morning to you. And also Monkey Man, good morning. Do let us know why you're thinking about getting back into Palantir so soon. So soon ahead of the correction that that
Mr. Banging the Drum for One for 6 months has been.
Did you hear me bursting out laughter when you cracked that joke about what?
Like my definition, it's not mine. I've stolen it from somebody else.
Stolen
yes,
it.
That's the definition of a bubble.
Yes. And OL102 saying coffee for Ange to wake up. Yes, indeed. I've only had one espresso this morning. I need another 3.
See, I've not had any actually because I've been in here.
I know you
soldiering
have.
on.
Yes, thank you so much, Terence. Someone did mention LSEG and Greg's. I did take note. Boise also saying woolly jumpers on today.
Yes.
Summer's over. Yes, this morning it was very, very chilly. Just quickly taking a look at LSEG for you. Have you heard of the terminalist?
No.
So no one actually knows who writes the article. This is specifically for our trader friends and those on Discord. And Davy J100 asking about LSEG this morning and asking what's up, Ange, with the shares. Let's have a look at that. That's the daily chart. And
I can't remember if I still hold these. I used to. They used to be a cracking investment.
there used to be a divvy hold, right? But I think
so.
the dividend.
I bought them because the chart was going up.
But look at the chart now. It's quite painful.
Yeah, well,
So if you look to the left, we are at levels. I'm going to draw the area of interest here.
it did go up tenfold between 2010 and 2020, so there is a bit of a...
Yes. But if you still held from February all the way till now, you would have seen a huge drop off, and it's now trading at around levels last seen July, October 2023. And given this is the weekly chart, taking a look at the monthly as well, because you can see just how much it's fallen. Those big red candles there.
It's interesting you talk about levels to watch, because the other phrase I like is everyone's a chartist in a sell-off, because it's always, even the most dedicated fundamentalists will start looking at charts and pulling out levels to watch when it starts to come off like that. So it's very interesting, but that's what we're doing right now. So
Yes, but it's also good to kind of think, if you wanted to get in, it's also good to pull out a chart to see, you know, where the last bounce back was.
yes, exactly, very, very true. And of course that's definitely moving into, or is this turning into a buy the dip opportunity? The problem is sometimes dips get bigger, so dips get dippier, as they say. So it'll be very interesting to watch this one.
Yeah.
Why is it doing this? Why is it particularly decided to fall out of bed like this?
So I was waiting for you to ask me.
Finally scripted machine.
Kim, this is not scripted, by the way, so you know that we're always, you know, giving you the best stuff here. You're hearing it first because this is actually not scripted, and it is prompted by you friends, especially Davy. So, have you heard of the terminalist? No one really knows. I'm going to show you the terminalist here. I'm also going to put the link up. No one really knows who is the terminalist, who this writer is. Some think he could be a board member. Some think that he could be a huge shareholder or ex-shareholder. And you can find it as a Substack that many in the city talk about. Sometimes, you know, as you're starting a morning meeting and people have dialed in early, these are amongst the analysts in the city. You go, do you see what came out on the terminalist recently? Well, one that piqued my interest, because I have had a lot of dealings with the London Stock Exchange in my previous 2 lives. In fact, I just had dinner with them, one of them at Le Coq, I love saying that, on Friday. There is this story about how the London Stock Exchange acquired Refinitiv, another company which I've had a lot of dealings with, but they paid over the odds. They paid a huge amount, and they accumulated. What happened was they then gobbled up billions more in debt and depleted half of its retained earnings. Now, as I said, have a read, Davy, and have a look at all this, because it is interesting always to find out what everyone else is reading in the city, those that you know, have to explain why they've come out of LSEG or looking to get in. This is why we look at charts as well. We don't leave fundamentals and just take the fundamentals. We also have a bit of chart knowledge to give us that heads-up display. But the crux of the matter is LSEG didn't do its due diligence, and it bought what was Refinitiv at a too high a price. I know this because I was working at that time before IG at Reuters, which had the bit that is now called Refinitiv. So that's a short answer to your question. As I said, this is all in the terminal list, which is available to the public if you want to read. No one knows who the terminal list is, but it's written very well, like someone who is on the inside.
Do you have to pay to subscribe, or is it free?
No, it's free as
Is it?
far
Wow.
as, yeah, it's free. And you know, every sector, friends, have their own version of the terminal list, right? So, you know, the luxury sector have their own, and when the news about Burberry potentially looking like a takeover target, everyone was looking at Mrs. Checkers. Is that the one, Mrs. Checkers? There's a like a Substack or a writer. But,
Oh, is there? Right.
but no one actually knows who the
You
writer
said that, I thought you meant it was the
is.
Prime Minister's wife, but there we go.
Yeah, have a look. I'm going to put that in the chat after the
interesting.
show. So do have a look as well. It is something as well that's being watched by people within LSEG with great interest, I shouldn't laugh. This is all not trading advice, might I add. This is just giving you some ideas as to where to look if you are wanting to poke holes in your own theory or to find further clues as to what you should do with your investments. Right, the next one. Let's have a look at Greg's, shall we? Do you like Greg's?
No. Share price or the company or the food?
Both.
Oh, neither then. Well, maybe the share price. As previous regular watchers will know, I don't go into Greg's.
Is it because you don't consider it food, or is it because...
It's just never, I don't ever think of, oh, I'll just pop in for a Greg's. I don't know. Call it blind prejudice. That's all it is, really. Interesting, because the FT said, it was a couple of months ago, I think it was, have we reached peak Greg's, was the article they were running, which is interesting. Certainly not a share price to love, anyway.
No, it is, you know, looking at this chart here, a sight to behold. And to be honest, I'm going to raise my hand, I do feel that it has been unfairly punished, because one of those red candles, I believe, was on the day when it came out saying that hotter weather has meant that its products
Yes.
haven't sold as well. And just on that comment, it got punished. Absolutely pummeled. And just put a daily chart for you. I think it was somewhere around July, if I'm not mistaken. Do check it and let me know. But you know, Greg's has been a really painful chart. It has dropped some 3%, perhaps even more, in the last 6 trading sessions since its ex-dividend date of September the 11th. The company did pay a dividend of 19 per share. And what's also interesting about Greg's, Terence, do you eat Greg's? Do you go to Greg's to eat their food? I'm a big fan of their vegan sausage, because even though I am not into vegetarian or veganism, it doesn't taste too bad.
I'll have to take your word for it. It's highly unlikely, A, that I would go into Greg's, and B, even more unlikely that I'd go and try the vegan sausage roll. It's incredible how in 2022, they were £33 a share. 33, the tenfold return from where they were in sort of 2012 or so. Mm-hmm. And now look at where they are. I mean, the share price, the weekly chart, the monthly chart, in fact, it's brutal. The ride is incredibly volatile, but it does look like something's begun to give. And as Axel would point out, of course, we are below those October 22 lows now, which is particularly worrying from a longer term perspective.
Yeah, and speaking of Axel, he is waiting in the wings.
Oh, good. We'll see. I've queued him up.
I know.
It's still not scripted. It really is.
You must have put a chip in his neck and it's working.
Well, I always know where he is, just in case.
He's out there with a Greg steak bake. No, he isn't. Any questions for Axel? Do slam it into the chat now. We've had quite a bit of chatter around uranium as well. So if you want to talk uranium, I know some people have asked me about this, because I have a position in Sprott and it is starting to fly since the end of summer. We will be talking about that with John Mayer when he joins me later on for a Commodity Corner.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show's finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, the fittest, mentally the toughest, but the cash returns. That's something else. Watch and learn. Come on, Pat. Cash returns, come on. Hey guys, where are you going? You're not going to get better than cash returns.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission-free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves. Welcome to the Art of Investing, a brand new podcast to help you achieve your investing goals.
And I've seen at first hand the power of the wealth creation that one has been able to obtain from this industry. What we're going to do is we're going to put it into action by creating our own model portfolio.
We're going to be talking about the big indices that are around the world, because that is probably some of the safest ways for you to invest your money.
We need to bring this to everybody and help them then take control of their own investment story.
Join me, Rich McDonald, and my co-hosts Mark Spice Holden and Chris CJ Fellingham every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience.
Hello and welcome back. And for those of you who know me, Axel Rudolph, I'm going to look at charts, and please send in your charts so we can analyze those together and look at some technical analysis now that Angeline and Chris have talked about the fundamental side of things, we can switch to the charts. So whilst you send your questions in, I'll start with Trade of the Week. So welcome to Trade of the Week on Monday, the 22nd of September. And if I remember correctly, the last week I didn't put a trade on because I didn't have a clear signal with a high probability, low risk setup. Now, today's Trade of the Week, unfortunately for you, has already moved 100 points in the direction I wanted it to move. But basically, it is to go short the German DAX 40 index or the cash index or the futures contract. In this case, we'll look at the cash index, as you can see here on this chart. And let me just make it bigger by pressing F11 on my screen because I forgot that. Here we go. No, didn't work. Let's try again. Here we go. So I was saying Trade of the Week to go short the DAX. Why? Well, for fundamental reasons, the S&P 500, the Nasdaq and the Dow have made record highs over the last few weeks, nearly every single day, and yet the DAX declined, as you can see here on the daily chart. So we're seeing relative weakness in the German stock market compared to the US stock market. And what's been happening is that we saw a rotation, and we're still seeing that out of the powerhouse of Germany, so German stocks, powerhouse of Europe, I should say, and basically back into US stocks, into the tech stocks in the US, etc. So we have relative underperformance. And technically, what I also found interesting is that we've had this downtrend line. Now, with the Fed move last week, we had the DAX rally very strongly. But can you see here, we just tested that resistance line, and then we came off again. And this morning, I had a sell signal just below that low here from Friday. And as I say, we were already trading 100 points lower. So would I get in now? The risk reward has changed since then, so probably not. So we'll still put the Trade of the Week on as if we didn't see today's move. Maybe it will bounce back, who knows. So the idea is you go short here because we believe that's just a spike like we saw back in early September, and that's then going to be followed by another down move. So what we want to do is go short around 23,600, put a stop loss above not just the downtrend line, but also the last few reaction highs here, just slightly higher, probably just above 23,900. That's the 5th of September high, and a downside target probably around 23,200 or even lower than that. So today's Trade of the Week is to go short the DAX 40 at around 23,600 with a stop loss around 23,900 and a downside target around 23,000 or even lower than that. So technically speaking is up now. And just to go back to the Trade of the Week. Now, as you all know, I don't trade any of these setups because otherwise I would have waited, for example, this morning for this show to air and trade the DAX short, for example. But my signal actually was triggered, as you can see here, on a move below the low we saw on Friday. And also, if you looked at the intraday charts, which I looked at, you can see here that basically we've been declining ever since I was ready to trade this morning at 6:30. So the earlier bird catches the worm, and as you can see here, it clearly did so. On 7 o'clock, we had a small move higher, but then we had lots of opportunities to just sell into this downtrend here. And we just had another one, and we might have another opportunity now on the short-term charts, 5-minute charts, as you can see here. You could still sell here, have a tight stop above these highs and see whether we go lower still. But basically, I'm trying to trade the trend. And what is the trend? And that's the problem with a lot of people. They try to counter trend all the time. Well, I looked at the daily chart, and here we can see, for example, my simple moving average here, the 30-period moving average pointing down. That's a downtrend. We can see here that my hourly charts also started to turn down earlier this morning at around 6 o'clock. That's also pointing down. And we can see that, for example, my 15-minute chart, if I go on the 15-minute chart, also was pointing down since this morning. So basically, you've had several different time frames pointing lower. We had the fall through Friday's low, and we also had intraday everything pointing down. So that's the direction I chose to trade in, because that's where the trend is heading to. It's heading down at the moment. Now, with regards to trade of the week, well, the problem is I come up here, I do the show at a certain time on a certain day, but markets are not going to do what I want them to do on a certain time, at a certain time on a certain day. So that's why I don't trade these setups. What I look for is the setups, and I'm ready for these setups to be triggered at any time that I'm available to trade these. So anyway, long story short, you can see here, if you go short now, you could still do this, but then obviously your risk is now 400 points. And if your downside target is 23,200, your possible profit is 500 points. So it's just about possible still. It's just above 1-to-1 reward to risk. But what we're aiming for is to make it sort of 1.5 reward to 1 risk, or even 2 times the risk we take in terms of profits. But either way, we're trading in the direction of the trend. And I can't stress this enough. A lot of people try to buy the bottom, buy whatever minor bounce you see, and then they get frustrated because it's just a bounce in a trend. And now the trend is pointing down. Question is, what about the long-term trend with regards to the DAX? And that's still pointing up. As you can see here, we had the sharp up move, sharp down move here into April, then sharp up move again, and then we've seen a sideways trading range ever since basically June of this year. And what we're seeing since the high seen at the middle of August is a downtrend, which is taking us back to these lows, to the August and early September lows. If that early September low goes, and I'm not saying it will, but if it does, we could quite quickly head back down again towards these lows here seen in June. And then if that were to go, then we would be forming a major top formation and we could have a significant correction. But unless that happens, we're just trading in a sideways trading range within a shorter term downtrend. So an uptrend, which one of you want to look at, is gold. And you can see that gold basically continues to trade in record highs. We're just making another record high. We still have a lot of central bank buying. We still have the Bank of Japan and mainly also the central bank in China buying gold, as you can see here, trading new record highs. I've got a long-term upside target, which I've had in place for years. I think it's 161.8 Fibonacci extension level at $3,745. I don't think I've got it on here. No. But basically, that's a long-term Fibonacci extension. I'll just mention the level again. 161.8 Fibonacci extension from a previous move decades ago, I believe, comes in at $3,745. So perhaps we might stall there, but that's the upside target I still have in place, and we're very close to it now. We're trading around it actually on the daily financial bet, but if you look at the cash level, that might be slightly lower. But yes, so that's an upside target, Fibonacci target. The next level I've got is basically psychological number, around number 4,000. So gold for me remains bullish. I remain long. Basically, if you are a shorter term trader, where's your stop loss? Well, you've got this last reaction low here. Let's just make it slightly bigger. Going back to Wednesday of last week, Thursday's low. And then you can see slightly below there, you also have here that low going back to the 11th of September on the daily financial bet, around 3,651. So basically, as long as we stay above there, the trend's your friend, still looking bullish. And yes, I mean, you could say, last week, I might have said to some of you that we did see some slight negative divergence. Can you see here the relative strength index made a lower high than the previous one here, yet we made a higher high on the price chart. And we did have a small dip after that because of that probably, but then we had a new uptrend. And you can see here we're heading back up again. We may soon rise above this relative high here, in which case the negative divergence is no longer valid. And a question I received from one of you is to ask, well, should I look at my relative strength index or should I look at the price chart? Price is always the most important factor. Price is nothing else than the difference between buyers and sellers, the equilibrium between demand and supply. That's what everybody's looking at. That's what the market is trading at the moment. So price is the most important thing you want to look at. And then you look at the derivative of price, which might be an oscillator, an indicator, or here the relative strength index. So these come as secondary indicators, same with the simple moving average or anything like that. Another question I've got, thank you for sending these in, is IBM. Let's have a look at IBM. And you can see an extended hours chart here. Looks very much like the gold chart. You can see trading higher, but from a longer term perspective, it doesn't, because the gold is making all-time record highs. But here IBM is just resuming its longer term uptrend from the 12th of August low. You can see here we're heading higher again. And we can see that longer term, we're still in an uptrend here. But we do have these pretty significant declines. But you can see here, if I were to draw an uptrend line on here, we're still positive. What I like about IBM today is that it is trying, as you can see here, to break above these highs going back to February of this year, the February-March highs. And what I want to see today and this week is a daily chart close above that 5th of February high, which on the daily financial bet was made at 26,709. And if we were to rise above there on a daily chart closing basis, that for me would mean we break that resistance. Ideally, also, I want to see a break above these highs here, the mid-May highs on the daily financial bet around 26,931. Because a break above there means we've broken through that resistance, this resistance, and leaves it way open to go back to these highs from July. So right now, it looks encouraging to me. We do have a series of higher highs, higher lows. We have risen above the last reaction high here. That to me indicates we've bottomed out, and for me, IBM is bullish now, provided it stays above the last reaction low. As I say, a reaction low is always a low which is lower on the candlestick or on your bar chart, below the one to the left and to the right. That was made here on the 12th of September low, and that's at 25,223. As long as we stay above there, the trend, the short-term trend is your friend, and that's still pointing higher. So I think that one technically still looks quite interesting to me and bullish. There's another one here, OMI, which I don't know much about. I guess it's this one here. Here it's interesting, but because what we've seen is what I call an ABC Elliott wave correction, move down, move up, move down. And this move is similar length to that one, slightly longer, but that's just a corrective move after a sharp up move here. And basically for me, that is still bullish because that's just a corrective phase in a sharp uptrend. And as long as we stay above last week's low, which on the daily financial bet was made at 1915, for me, the odds are greater that we will take out this high here and continue to rise than any reversal to the downside. If we were to fall through that low, though, and close below there, that would indicate that we formed the top and that we're ratcheting probably back down again towards the 15 area, or even this high here made on the 12th of August, 1380 or so. But right now, short term, this looks to me constructive. You can also see that the candles are becoming longer again. And we've today basically already taken out that previous negative candle here and trying to close our gap here. So that's all quite encouraging. To me, that looks bullish. Let's look at another one, which I don't know much about, ALRT. Defense Holdings Limited. You can see here we've had a swift decline here, but now we're gradually heading back up again. Because this up move has been quite consistent, I expect further upside to be seen. I wouldn't be surprised if we retest the highs seen earlier this month. So for me, that is still looking constructive. If we were to take out that high, we could go back to the 250 area on this daily financial bet, and also towards the July high of 2022, which is made at 265. So that would be my next upside target. And that also coincides with the high seen here in May of 2022. So that might be a future resistance area here. But yeah, short term, that looks still quite positive to me. It is constructive, provided we stay above the last relative low. If you can have a stop loss which is further down, then ideally it would be this one here, because that's where we had the big reaction to the downside from which we bounced back again. So that one would be if you have a wider stop here at 102, but if you want a tighter one, it would probably have to be this one here at 145. As long as we stay above there, this is still looking bullish. So for me, further upside more likely than any downside. Now here is a stock that I do know something about, Palantir. A lot of us like that stock and look at it, and you can see here we again managed to go higher and are approaching our highs seen back at the middle of August of this year. You can see longer term, we have a very healthy uptrend here in place, and we continue to rise. And we can see here that basically Palantir is still looking very bullish. Now, short term, it is coming off a little bit in the overnight session, but let's wait for the US session to see what happens next. But even so, look at that. I mean, that high made a higher on the relative strength index compared to the previous high. So we're just confirming with the relative strength index that the current uptrend is healthy, is likely to continue. So for me, that upside target here, the high seen on the daily financial bet around 18,905 still remains in play. If we were to go above there, then we could just trade in new record highs and approach the 20,000 mark on the daily financial bet. But you can see here we have a very healthy uptrend here in place. We've had a correction like this before, that one we saw a few weeks ago, and then we just continued the uptrend. So Palantir is still looking good. I wouldn't be concerned about this chart at all. Now you can see how I incorrectly drew in this trend line. Why is that incorrect? It looks right, doesn't it? Because it touched this point here. But if you go on here, can you see we have that little kink here, which is below that trend line. And you don't want to do that. That is incorrect. So if that is the case, you need to redraw your trend line and make sure that no data is going through there. So I'm going to the lowest point there, connected up with this point here. Now we can see no data going through this one. You see that one is the correct trend line. Now it doesn't matter at the beginning, but the further in time you go, the more a slight discrepancy will have an effect on your trend line. So for me, Palantir is still looking bullish. If we look at where the stop might be, well, the last reaction low where the hammer was, can you see here? That one hammered out a low here on Wednesday of last week. So we opened here, went all the way down again. That was on the Fed, and then up again. And then since then, we've had a very strong up move here. So as long as we stay below, above that low, and that on the daily financial bet was made at 16,131. As long as we stay above there, for me, the uptrend is still very much intact. Now let's look at some UK stocks. Let's look at Lloyd's to change the subject a bit. Lloyd's Banking Group, great dividend stock. I think I recently wrote something about Lloyd's. If you want to have a look at that, just Google my name and Lloyd's. And you can see here why I liked Lloyd's and why I was bullish Lloyd's. Can you see here we had this previous resistance area, which then, because of inverse polarity, basically became a support zone. Can you see here that these previous highs acted as support? Now, sometimes intraday you go through a support level, but if on the next day you have another move in the direction of the overall trend, it's still valid support. You can see here we bounced off there. And then interestingly enough, when we came off at the beginning of August, went all the way down to that support level and then had this really, really strong candle to the upside, still looking bullish. Now, what can we see from a trend perspective? Again, we're seeing a series of higher highs and higher lows, and you can see here that we remain above that uptrend line. Yes, we've tested the previous resistance line just last week. We intraday rallied above the high we saw here on the 22nd of August at 84.60, but then closed below there. So that's not positive. Also, that higher high than this one has not been confirmed by a higher reading in the relative strength index. Can you see we have a lower high compared to the previous one? So we had negative divergence, and then the bounce also last week failed on Friday below that previous high and also the August high, which is also not positive. So technically speaking, for me, that indicates that potentially we might actually come off this resistance area and perhaps glide back down towards perhaps these highs here, going back towards the 80 area, or even the highs seen on the 23rd of May, around 79 cents, and where the uptrend line comes in. I wouldn't be surprised if that were to happen if we were to fall through Friday's low here at 81.37, because that would probably then indicate, oh, we actually have further downside in store. If that's not the case, this might just be an ABC correction, and as long as we hold above there, we may have another attempt at the upside. But for me, this level here, Friday's low, is a line in the sand, short term, to see whether we can head back down again slightly lower. But even then, longer term, it's probably still a good buying opportunity, because as long as we stay above the low seen here, below the 3rd of September low, this is still a very healthy uptrend, just capped by resistance. But that happened also back here in March and April, and it then still led to higher highs being seen. So I wouldn't be too concerned. But yes, short term, we could come off. If we go below Friday's low, as long as it holds, we may retest the highs. Now, what happens if we take out that high we saw in August and continue to head higher? Well, what we can see here is that the Lloyd share price is already trading at levels last seen in 2015, and would then head towards the highs seen here in, I think, January 2014. That was around 85. And then we had also 88, 89 here, May 2015. But yes, looking very healthy indeed. Let's also look at, let's go back across the pond to Walt Disney, 24-hour chart, as we can see here. Now, this is the weekly chart on Walt Disney. And why am I showing you this one? Because I got a question about it, but also because it's looking quite similar to the short-term chart on the Lloyd share price we just looked at. And you can see here, this is the weekly chart. And you can see here that the highs in August 2022, February 2023, April 2024 were tested in June of this year. And then we failed. We came off again. We had this retest we just saw in the Lloyd share price and failed below this previous low and the low seen here in April of 2024. This retest here. And then we came down, tried again, and now we're coming back down again. So the question now is, will we hold at these current levels, or will we fall through the August lows? In which case, we could have formed another small top formation and we might slide further. So let's look at that on the daily chart to make it clearer. So you can see here that that was the retest here, failure down, gradually heading up, failure at this resistance here, and then coming down again. The fall through here, the 2nd of September low, was bearish, taking us down towards these lows here. So that's what is the main reference point for you now. If you're long Walt Disney shares, on the daily financial bet at 11,155. That's the low from the 11th of August. As long as we stay above there, we may bounce back. But here, the trend since June has actually been pointing lower. We have a series of lower highs and lower lows. So if that were to give way here, we have a slightly lower support level here at the 23rd of May low, around 10,875. But a fall through there would mean that we're forming here a top, and we could then slide all the way back down again towards 10,000 if that scenario were to play out. Now, as long as we hold above this low here from the 23rd of May, this might just be a corrective move, a larger ABC correction, down, up, down. We may hold here again, and then we may go back up again, because longer term, as you can see, we're still going up. We're just consolidating like we did here. But my worry is we're going to consolidate like this, and then once we fall through these lows I just mentioned, we could have a deeper correction before the share price goes back up again. So just watch out for that. As I say, reference points for me are the 11th of August low, and if you want a lower one, the 23rd of May low, but a fall through there would really not be positive. Provided we hold in these support areas and bounce back, the share price might still be looking positive and bullish and not a problem. Now let's go back across the pond, but to Germany. Let's just look at Deutsche Börse, the German stock exchange, and see what that looks like. And you can see here Deutsche Börse did what I just looked at on the previous Walt Disney chart. Basically, we had a retest of previous highs, failed then below the previous lows here, tested our long-term uptrend line here, retested the previous low here, which was support before, and because of inverse polarity became resistance, and then we fell through these previous lows and the uptrend line, and since then have been declining. And Deutsche Börse, I think I mentioned a few weeks ago and saying, you know, it did still look bearish, and we took out the low on the 27th of July, and then more importantly, this one I probably mentioned, the 6th of April low, and that was then here, that support area, but once we fell through here, it really is going back down again. Questions, how far can we go? Well, we don't know. We're testing this sideways trading range going back to December of 2024, but that also coincides with these highs here in October 2024. We may short-term find support there, but it's not that certain. So, you know, it could actually go, if I look at this chart, in my opinion, quite a bit lower. I mean, I wouldn't be surprised if we hit the November 2024 low, which was around 20,595. So if you're short, it's looking good. If you're long, well, where'd you get out? I mean, you should have gotten out at higher levels here already, but if you're still long, I would probably say, from a very long-term perspective, the low here back in August of 2023, around 17,628. But that's a long way away from where we currently are trading. If you want a tighter stop, probably the low here, the November low from 2024. That could be your reference point. But yes, the trend's your friend. That one's pointing down, I believe. Yes, not looking good. Let me look at one last request here. Let's look at RBLX. Roblox, exactly. Terence just told me in my earpiece here. Thank you for that. That's looking much more positive. I don't know much about Roblox. An all sessions chart. Let's look at it technically. So when we don't know anything about a share or a chart, what we try and do is go back to the longest time frame possible. I'll do that in a minute. First, I'll put my uptrend line on here, and it's clearly valid. Still looking good. And now let's also look at the monthly chart. We can see here Roblox made a new, I believe, according to this data, all-time high, at least on the daily financial bet here with IG, and that was in July of this year. Then we had a correction lower, and then we basically are trying to retest the previous record high going back to November of 2021. And let's just look at the daily chart. What happens here? Well, basically, we've been rising. We're just trading sideways here, but the trend is still, your friend, is still looking positive. It's a gradual advance, but you can see here we are trying to still hold above the Fed cut low we saw here on Wednesday of last week. That was the hammer formation. Usually what you want to see is a follow through to the upside after hammer. We haven't really seen that. We're just trading water here, but you can see we're remaining above our uptrend line, the 30 period simple moving average, 30-day moving average, and medium term above the low seen here on the 15th of August. So for me, technically speaking, the trend is your friend. The long-term or medium-term uptrend is valid as long as we stay above the 11,210 low on the daily financial bet made on the 15th of August. If you're a short-term trader and you're long, then I would probably have my stop loss just below, not just the hammer low here, but below the uptrend line, because that's really where the support is. If you want to, you could make it even slightly lower here below the 5th of September low, because that's the last reaction low below that trend line. So that would probably be my stop around 12,497. So that would be the last sort of furthest away stop I would allow myself if I were medium-term trading. If I were short on this chart, I would probably just place my stop loss above the last reaction high, which is the high here seen on the 15th of September, last Monday's high on the daily financial bet at 13,996, because a move above there would probably lead to us retesting the record high here on Roblox and further upside being seen. So this is the roundup of all the stocks we wanted to look at. Oh, one last one very quickly. We've got 2 minutes left. Vodafone. Yes, I can look at Vodafone. We've seen what we are just looking at here with Roblox, but here we broke through the uptrend line and the 30-period moving average, as you can see here. And then, as you know, for me, the really important bit, we fell through, when we have this trend line break, we go to the left and we fell through the last reaction low, this hammer low here. That's where we fell through. So there, that was negative for me. For right now, I believe that Vodafone is looking less bullish than before. It's still in a very healthy uptrend. This could be an ABC correction. So basically, as long as we stay above the low seen on the 31st of July here, around 80.70, for me, the long-term uptrend is still valid. That could just be a sideways ranging trade. But over the last few days, we have been drifting lower. And if we fall through today, the low seen on Friday, then we may actually drift down towards these lows I've just mentioned. And that's when it's going to get interesting. But yes, right now, short term, looking slightly bearish. Longer term, still looking bullish. But yes, Vodafone is correcting lower in the short term. Thanks for watching Technically Speaking. I hope to see you again on Wednesday for Charting Crypto, or next Monday again for Technically Speaking. Thanks and goodbye.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show's finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, fittest, mentally the toughest, but the cash returns. That's something else. Watch and learn. Come on, Pat. Cash returns, come on. Hey guys, where are you going? You're not going to get better than cash returns.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Welcome back, friends, and we are here with John Mayer for Commodity Corner. Good morning, John. How are you?
Morning. Yeah, good for a Monday morning.
You have a different background this time around. Did you cycle in early to the office, or are you somewhere else?
I'm in the office, cycled in. Not so many people trying to step in front of the bike this morning, which is good. Last Monday was something else. Everybody wanted to jump in the way, which is quite... You know, there are a lot of people in London who look the wrong way before they step off the curb. I guess it's because they grew up in other parts of the world, and one should be forgiving, but it's a hazard when you're cycling in.
It is. I don't know how you do it every morning. I take my hat off to you. I have tried cycling before, and took the last bit before London Bridge. I decided it wasn't worth my life, so I would actually park my bicycle quite, a distance from the office and just walk across, because I valued my life more than
Well,
anything
London
else.
Bridge is a dangerous place. There's no doubt about that.
Speaking of danger, do you have to navigate crazy car drivers as well?
Yeah, there are a few of those. Well, the thing about I grew up driving in London, and it used to be pretty easy to get around, but you kind of knew what everybody was doing. Now it's very different with all these Uber drivers, line bikers, whatever. Frankly, it's terrifying. Even I find it pretty terrifying to drive around London these days. It's just not the way it used to be.
Absolutely. Now, let's take a look at oil because, oil prices are still trending lower there. The reason I'm asking about oil is because many of our friends here have a position on WTI. Have you got an outlook for us, or certainly is there mood music that you've been hearing during your business calls and travels surrounding WTI for the next few months into the end of the year?
Look, I think it's pretty steady. I think there's a lot of geopolitics in oil and gas at the moment. Certainly, the world is moving towards more and more electric vehicles, and that is having a dampening effect on demand. But remember, oil is an extremely cost-effective and efficient energy source. So, I think there's large parts of the world are not going to give up oil or gasoline and diesel for a long, long time. Mm-hmm. Yes, the Western world and developed economies will go increasingly electric, and China is definitely heading that way as fast as it can, because China hates the idea of importing much of anything. It wants to control its commodity inputs. And that's a long-term mantra the Chinese have had. So, yeah, I don't see oil as suffering particularly, but I don't see the demand making it go crazy either.
Yes, we often look at oil as also a barometer of geopolitics. It hasn't actually moved much recently, which is quite interesting. This year as well. Just quickly showing this here because I think our friends might find this fascinating. So this is I hope you can see this, John, and this is a picture of current oil prices that's being offered to those in Malaysia right now. Malaysia, of course, provides first grade oil. It has its own first grade oil, the best. They sell the best stuff and they import in the lower grades to run things like their buses and things. But I thought this would be quite interesting. So have a look. Harga means price. Warga negara means they are citizens. 199 ringgit per litre. And that in pounds, friends, is 30p per litre. Compared to our, what is it right now? 139, 140, John?
That's about right, yes. But there are huge differences depending on which garages you go to. So there can be up to 10, 12 pence difference per litre.
Yeah.
So shop around, but don't drive too far to get to the cheaper fuel.
Let's take a look at gold now because, we've talked about this a lot. Many of our viewers asking for an update on your views on gold. We've seen it climb ever higher. Lots of buzz on Discord as well about the iShares physical gold ETF as well, moving higher. What's your projection this week?
Well, gold typically doesn't go up quite in a straight line, but this is about as straight line as it gets. It'll go up, it'll pause a bit, and then it will go up again. And we're in an environment where it seems easy for the gold price to go up. The Fed is, investors are now looking at the Fed cutting rates again and possibly again after that. I'm not sure we could do another 50 basis points this year, but probably another 25. The dollar index didn't weaken overnight, interestingly enough, but there seem to be forces pushing gold higher. The gold premium in India has risen again. That's $7 an ounce. Although gold premiums in China are slightly lower. Gold ETF holdings are markedly higher since Friday, so there's quite a lot of buying there. Also, we saw, actually talking about Indonesia, the gold bug seems to be buying Indonesia, according to something I read this morning in the Nikkei weekly newspaper. So maybe there's perhaps the Indonesians have got a lot of cash to throw around, or perhaps they are like everyone else concerned about the number of US dollars in circulation. It feels as if Donald Trump is going to print quite a lot more dollars. There are other countries in the world, let's look at France particularly, that are really struggling or grappling with the concept of cutting their national debt. It feels as if we're in an environment where nations are going to print more currency, and in that environment, you want to be holding hard assets, frankly.
What would you say to our friends listening in and they're thinking, do I go for an ETF or do I go with physical gold with Sharps Pixley, for example?
Okay, I'm a big believer in owning physical gold. I mean, partly if you hold a bar of gold, it's a wonderful thing, and it's not the sort of thing you want to put down again. But also, let's say something goes wrong with the banking system. Let's say there is a cyber attack against the global banking system. I mean, we've already seen Jaguar Land Rover go down, and that's, those guys would have had very robust systems in place. Who's to say that the Russians, the Koreans, maybe even the PLA out of China, who's to say that they won't attack the Western banking system and try and take it down? So, in the ultimate disaster scenario, physical gold is the thing to own. Otherwise, if you think it's really just about it, it's more about a debt crisis than anything else, then hold the ETFs, because that's much easier. At the end of the day, if you're holding an ETF, it's a pretty safe thing to hold on to, but you are trusting that the banking system is going to be there to pay out that ETF when you want to get your cash back. If you want to get your cash back, of course, or convert that into some other hard asset. I mean, all assets are for trading one way or another, but yes, it does feel like gold is pushing higher because so many people around the world know it, understand it, and want to own it.
We've got, of course, the Indian season coming up as well. Do we think maybe gold 3,800 this week, next week? Do you think that's too far a stretch?
It's certainly heading in that direction. I think we can get there. Yeah, it's. I mean, a lot of people are calling for it to go through $4,000 an ounce. We're not that far away. If you think this time last year, we were almost exactly $1,000 an ounce lower. I mean, that's a really big move.
It is a huge move because this time last year, I was being mocked for saying 2,800. And that was when Frank Caberna was here all the way from Chicago in Tasty. And I said, I think it's going to head higher. And he mocked me and he said, it's had its run. He was all about K-Web. So he was all about China and tech-related stocks there because he was banging the drum about the bazooka, which did come but didn't continue. This was the thing. And so I had a position gold. And look at it now. I mean, like, 3,700. Who would have thought, eh? Lots of people chiming in, talking about that. We've got loads of people asking about uranium as well. So uranium is a really interesting one. I'm just going to bring up some of the ETFs that you can use to get into uranium. One of them is Sprott Physical Uranium, but you've also heard Luke Moore talking about yellow cake here as well. Which ones do you particularly like, and how, first of all, do you like this market, this instrument?
I think longer term, certainly. I mean, there are stockpiles of yellow cake, which is the raw material. concentrate for converting into nuclear fuel. And yeah, you can store it, and that's what funds like Yellowcake do. They don't replicate the price exactly, but they're not far off. So they get there in the end because people are trading Yellowcake separately from trading uranium. Yeah, the Chinese are building a lot of nuclear reactors. We have news now that we along with the Americans, I think, are going to build a lot of mini nukes. The Japanese are turning nuclear reactors back on. If you cast your mind back to the Fukushima disaster some years ago, when the Japanese turned everything off, pending very substantial safety reviews. So they've done all that, and they realize they need the baseload energy. And I mean, the irony of nuclear power is that, or the irony of renewable energy is, the more wind and solar power you put in place, the more nuclear baseload you need to go with it. I mean, one day, looking forwards into the future, we'll have a lot of battery storage. And so the wind and the solar might be able to manage it on its own, but that's some years away. I mean, somebody needs to develop some better batteries, and the cost needs to come down a lot for that. But at some point, nuclear is not such a cheap option anymore. So it's because of the huge cost of building these things, certainly in the UK, and I imagine they're about a tenth of the price in China. And of course the management of these things, and then the decommissioning costs, which is interesting. Yeah, so one day batteries and renewables will completely take over, but we're not there yet. I mean, people are talking about thorium reactors as well. Again, that's got to be 10 plus 20 years into the future, and maybe we'll get there, but it'll take a long time for any technology like that to replace the nuclear fleet that we have. So I think the world, investors should be looking for nuclear to be a major force of energy in the next 30, 40 years, and maybe beyond. And that means there's going to have to be some new uranium mines, and some new, there's certainly going to be, I would have thought, a pick up in pricing, because the cost of running these mines isn't any less. And nobody's, it's quite difficult to get these things permitted. They take a long time. I mean, if you're lucky enough to develop something in a country like Namibia, where the environment is much better for developing mines for uranium, then that's quite good. But the grades for the new mines tend to be lower, or the new prospects, and that means the costs are going to go up. And that, for me, says that ultimately the cost of uranium will go up for those reactors. And let's face it, if you're running a nuclear reactor, you're not really that bothered about the cost of the uranium. It's a very, very small part of your cost base.
Cool. And just wanting you to, poke some theories in the near term. The spot price, I've got this chart up here of uranium, has more than doubled in the past 5 years, but is well down from a peak of 106 touch in February 2024. And strongest since November 2007. Some in the market, John, are looking and calling $100, sometime next year. In fact, I'm trying to find the person that has called this Arkady Gevorkyan. So those of you listening wanting to check this out in greater detail, Mo, otherwise known as Pelican, look for Arkady Gevorkyan at Citi. This analyst is expecting the spot price to hit $100 a pound next year because miners may not be able to keep up with demand. The other interesting thing to check is also the World Nuclear Association. They have put out a report saying demand for this fuel to power nuclear reactors is expected to more than double by 2040. So with all this bullishness in that time frame, can you see anything that could derail this, John?
Well, looking at that chart, remember that price is coming off a very, very low base. When Japan shut down its nuclear reactors after Fukushima, I'm guessing that those reactors either dumped their Yellowcake into the market, or it was a depressive effect because they weren't buying any new nuclear material. So that price actually nobody was looking for uranium at that price. Nobody was looking to expand any new uranium mines, and certainly no one was looking to develop any new mines. So what that's done is it's created a problem for the mining industry. The price even now, I think, is not much of an incentive for anyone to develop new production. I mean, there are some brave explorers out there. There's always somebody out there having a look for a commodity. But I think, yes, you are going to have to go over $100 a pound as an incentive price to get new mines going, and that's the only way the production is going to come into the market. I mean, yes, there has been quite a lot of decommissioning of nuclear weapons over the years, and in fact, ironically, the Americans are still buying nuclear material from decommissioned nukes from Russia, I think. So it's a strange world that we live in, and that trade has been going on, although I believe the American lawmakers are trying to stop that. But then there's also news this morning, the American lawmakers are looking for permission to sink the Russian shadow fleet. That's going to cause more trouble, not to mention a few incursions into Poland and Estonia and places like that. So the world's looking like a slightly risky place right now.
Yes, certainly from the number of people at the DSEI a couple of weeks ago. That was certainly the mood music that I was hearing. Speaking of which, we have Maturin chiming in, who also has an ex-military background, very impressive one, asking about zinc. You happy to talk about zinc, John?
Yeah, well, zinc's one of the less exciting metals, frankly. I mean, its main use is galvanizing and castings. Now, galvanizing, well, if countries are building lots of infrastructure, you get lots of zinc-coated crash barriers and things like that. Used to be that the big market was corrugated tin covered in zinc. You see that around lots of certain parts of the world as a common building material. For me, I'm quite interested in this gigacasting technology that the Tesla and other companies are doing. And I wonder how much zinc might go into that. I think generally zinc is probably for smaller castings rather than the bigger ones. So it's something that we need to look into. But I wouldn't frankly, I'm not that excited about zinc at the moment.
Interestingly enough, and Maturin knows I like lines of resistance and support here. Maturin has mentioned that there is a nice upward looking support line there from around April, but also there are now signs that perhaps we could see a line of resistance at its current level. It could creep back up towards levels unseen since around mid-March. Zinc, I have to put my hand up, not one that I normally look at, just because I can get better volatility with silver and gold. But one thing to watch if you are looking at zinc is to pay special attention to the inventories data, which you can get through the London Metals Exchange. And zinc inventories recently have slumped in recent months. This, with an educated, guess hat on, would suggest that it's starting to look like a tight market for the metal. Let's have a talk about copper as well, because copper is one that many of our friends here have a look at. Are very often asked about it, because we had some other analysts on last week that said maybe 2026 will be the year for copper. What do you think, John?
Yeah, I'm all for it. The ongoing electrification of many nations is a very compelling argument. Can't make that argument for zinc, unfortunately, but certainly can make that argument for copper. As I said before, all the electric vehicle charging points, the connections to the substations, then of course all the wind farms, the solar farms. Let's not forget that solar is very good for silver. That's certainly helping to drive demand for silver and the price of silver. So copper definitely is going higher. I just think right now as in today, this week, and maybe for the next few weeks, all the attention is on gold, and that is taking the traders' attention away from copper and the other base metals. So I'm not surprised to see copper hovering around $10,000 a ton. I'm quite sure it will push higher, and maybe we'll see 11 or 12 by the end of the year. And then what I would look forward to is from December to mid-January, for probably quite a strong run as everybody reorientates their views on these metals and their holdings. And then I think copper will do very particularly well. And the market tends to anticipate these things. So it's quite hard to develop new copper mines. I know that Anglo American and Teck were talking about joining a couple of their copper operations and shall we say, mining a bit more in the middle. We also saw Codelco announcing something similar. So that means there will be a little bit more production. But again, it doesn't happen overnight. These things will take years to put into action. And in the meantime, there isn't much new coming on.
I love it that you can talk with such expertise, because it also allows me to draw your information on the chart as you're talking, John. So as you were talking, I was going to point out and draw these rectangular areas of interest. And for copper, what I'm looking for is that if we punch through and close above my first area of interest here, which is around that 10,200 mark, and if we close confidently above that, then if you look at the weekly chart, friends, and you go further back, the next area of interest is 11,000. Pay special attention to any sort of supply shortages as well. There is currently still a suspension of production in Indonesia's Freeport Grasberg mine. So yeah, those of you watching copper, these are some of the key things to look forward to. John, thank you so much. Always a pleasure to catch you on the show, and we'll be aiming to catch you outside the show as well on Friday. We've got Ron Williams coming up next with technical analysis, so stay tuned for that. Any questions for John? Send them to me on Ask@IG, and slam the like and subscribe button if you enjoyed that. Thanks, John.
Thank you. See you soon. Thanks, guys.
Maybe next year is a year for copper.
I'm reluctant to
thank
say
you.
copper here and now, just because it's
Yeah, you
been
too. All right.
volatile.
Background's okay.
So the best thing that I would recommend is for people to look at the commodity equity ratio, because that shows a generational rotation ahead, but it hasn't triggered yet. But if you look at commodities year to date, equal weighted, it's double digit. So commodities are an asset class that should really be better recognized. Weighting should be increased, and your IG audience, if they're not trading it, should at least take a look at it.
Hello, everyone. Welcome back. And we have a special treat for you, a brand new guest, but one that is very familiar with the markets and widely known in the world of technical analysis. Ron Williams, welcome. Oh, my goodness.
Great to be back.
So give us a quick introduction. Tell everyone, your history, what you've done so far, what you're going to... He does a lot of travel, by the way, so it was very difficult to align our diaries.
Basically, my focus is markets and mines, so it's a blend of the two. So markets in terms of market strategies, I've been doing that for 25 odd years, working with leading institutions, now run my own investment advisory research firm, and there's a consultancy part of that focuses on education training. The second part is, of course, the mindset, market and mind, and that's the realization that about 80% of what we do is all to do with subconscious behavioral patterns, and that in order to be successful at trading, we need to manage and raise awareness and then manage and optimize these patterns in a way that can be conducive to good trading. So I focus on both personally and with students and clients. And on the market analysis side, in brief, macro, tactical with a behavioral lens driven by cycles.
Nice. For those of you wanting to search for his work, just look up Ron Williams. And as a special favor to me, as I've known you for such a long time, I specifically asked Ron if you could bring in some of your special charts for us.
Yes, picture speaks 1,000 words. And I really think in charts. So hopefully that'll help with the visual engagement for the audience.
Nice. I like this one with the bull. Like, talk us through this.
Well, the headline theme is an emboldened bull still dancing on the edge. This is in terms of risk appetite that we saw first half of this year post-shakeout. And credit to Hedgeye, who drew the cartoon on a month-on-month basis. I look for these behavioral pictures that best capture the zeitgeist of the moment. It's a way of thinking laterally, having our biases in check, but then also understanding what the underlying themes might be. So this shows the bull is strong, yes, but it has been climbing a wall of worry, and it's been juggling live bombs during that process. So it is a face value positive sign of resilience, but at some point instability does show up, and you can see I've just labelled some of the live bombs: tariffs, geopolitics, and ultimately cycles. These are things that will continue to stay with us for a little bit longer.
Nice. So let's move on to the next page here.
Here and now, what we see is digital assets. Ethereum basically was leading, now potentially giving us an early unwind signal. Crypto acting as a risk-off potential, but Ethereum also outperforming Bitcoin for other reasons.
Equities, it has been for some time.
It has been for some time, and our main feature chart is of Ethereum as well. And look, switching from digital assets to equities, Japan and China outperforming the US, both at all-time highs. China's unwound a little bit, but with a very different valuation gap. And various other factors that are making it more attractive at the moment. So that just shows a little bit of global divergence taking place and rotation. Gold doing what gold has been doing for some time. The long-term trend remains strong, resumed higher, fueled by haven flows, but also resumption in inflation expectations with a broader commodity uptick. And that's the key thematic insight from this ranking model.
Nice. Talk us through duration, and you've labelled it strategic, tactical, and active. So talk us through duration.
Yes. So the key thing is to look for the outlier trends, up or down. But it's also important to look at rotation, and that is what we're seeing. Gold at the moment is in the strongest ranking trend, and it's consistent across the board. You can see it's a straight line across. Whereas Ethereum is strong on the left, which is the long-term annual trend, but has recently unwound, having broken above the 4K level. We'll see that shortly. And you can see it's outperformed Bitcoin. Bitcoin should be there. Further down lower, for those who can see the detail behind. Interestingly, USA, it's the market that we know so well and love in terms of price action liquidity. It's strong, but it is losing some momentum, and that is during this seasonality, typical volatile period of September and October. So a healthy unwind likely, especially for those markets that have moved the most and are overvalued.
Cool. So let's make this useful for, this is very useful, even more useful for our viewers. So let's say, we're looking at this and someone's in Ethereum, and we can see that it's on the strongest, right, on the left-hand side, but it's moved down to tactical, and then it's also moved down the list in Ethereum. What exactly should we take from this? Is it basically, in 50 in a quarter, in 3 months' time, perhaps you might want to reduce your holdings. In a year's time, if it moves further down and it moves into the active, but down towards neutral, should you then change it up so that you have even less exposure? I mean, how does should you have less?
Tends to back the ones that are the strongest, and on this ranking model, it's strong or strongest. If you wanted to get an early signal, store earliest, not before. We've backtested this many times over, including my mentor Robin Griffiths, who originally designed the model 50 years ago.
Oh, wow.
And we've evolved it over time to include global cross-asset. it works because it's simple and it's effective. And when we over-optimize, it works less effectively. But what we have realized is the best trends to back are once they emerge into strong and then strongest, the times to let go of those strong trends, because a trend remains your friend until signs of reversal emerge. I remind clients and students of that on a regular basis. That needs to confirm and follow through. But one of the signals on this model is a rotation out of strongest into weakest. So we typically look at the outliers, strongest and weakest, to see where the best and worst trends are currently, but also where they may progress. Now, your great question as to strategy and tactical really depends on who is in the market. If it's a long-term strategic investor versus a short-term tactical trader, based on their objectives, their strategies, risk, money management, and all the rest of it. But the best way to visually explain that point is the chart on the top right, which gives you an idea of the ripple effect. And you can see the big blue line giving you that long tidal wave move. But along the way, you get zigzags that take place throughout the market. How investors and traders take advantage of that ripple effect is down to their strategy and down to their objective at the time. So a tactical will look for short-term, swing opportunities up or down, depending if they want to take a long or short bias. And a long-term will buy and hold. Gold is a great example of buy and hold and buy on the dip. Ethereum, buy and hold because it's just been so strong and reflects the altcoin rotation. But perhaps lighten up now or wait to load up some more if it were to break up higher.
I'm interested, very interested in this wave because, what does your trend cycle model tell us about tech stocks? We have a huge number of clients that have positions in tech stocks. Of course, we've seen all indices in the US, keep climbing and climbing, despite almost ignoring any of the warning signals from the bond markets. And everyone's wondering, have tech stocks got too high, too soon, too fast? And where is this summer correction? So do you have any insight using this trend cycle model to do with tech specifically?
Happy to revert back to the question on the chart on the S&P 500, because that gives more hard and fast tangible signals as to what to expect next. Also, I say that given that the market has surprised so many times to the upside. So it is best to wait for real confirmation of momentum exhaustion, reversal and follow through. Otherwise, as is often the case, we're waiting for something to happen which hasn't. And part of that explanation, I think, is seen by safe haven flows that are extreme based in terms of macro uncertainty, both economic and geopolitical, which remain. They may ebb and flow. That seems to be the new risk-free rate now.
Yeah, it's the constant, the new normal, people.
It really is. And I think we're adapting to that, which is why we're still resiliently bullish. But we must still remember that there is a shaky ground that we're resiliently bullish on. And I think the other point, which has been evident for some time, demand from central bank institutions remains strong. And for the first time in 30 years, there is a crossover signal in central bank demand for gold over US Treasuries, and that's the chart on the top right. This is doing the rounds based on Bloomberg data, and it sends out the obvious point that the powers that be are looking to diversify, maybe for fiat currency reasons, but also this is out of Treasuries.
Yeah.
Safety is taking a new guise. Gold is now taking front and center choice over Treasuries.
Yes, and I often wonder whether the climb in gold might have been higher had we not had Bitcoin and digital currencies. It might have taken some of that, shine off gold, because that is now also being seen as a place a home for liquidity, as a safe haven away from fiat currencies.
Yes, absolutely. I mean, it's a double positive for both gold and crypto, and Bitcoin in particular, and perhaps now Ethereum. The best guidance is to own both, based on work by an industry colleague, Charlie Morris. He's developed an ETF index that allows for that. We can do it plain vanilla or do
Charlie
an ETF.
Morris is in Bytree.
Yes.
I know Charlie.
And I think it's a volatility adjusted index, but essentially I think it averages out 80-20, 80% holding in gold, 20% in crypto. So for those who are more traditional finance, macro investors or traders, you can just do that. Don't have to choose between the two, just own both. But the benefit is, if they're both going up as they are now, partly for safe haven reasons, but also fiat currency hedge and inflation risks, based on expectations, you win twice. But that's not the main reason. The main reason why you own both is if volatility kicks in, you have a cushion. Gold provides a cushion on the high vol that crypto typically displays.
Nice. We've got another question from the floor. Please ask Ron if he thinks it'll be similar for the Russell 3000. What do you want? You want to do Russell first? Or I know you've got this fancy appendix.
They're the key charts. Happy to work on the questions that we have. But to circle back to the original question, I think, which was on NASDAQ, the S&P 500 chart, if we quickly go back to that, paints part of that picture because, as everyone likely knows, a big part of market cap in S&P 500 is tech. So where this moves, tech will likely follow. And the key level there is at 6,400 last time I updated this chart, which is the 50-day average. But basically a reversal from that compression pattern. If it breaks up, a little bit upside, but if it breaks down, that's your downside flush out signal at the very least into 6,000. And that would be tech-led. Because tech is still hot, momentum is still strong to exhausted, and we're seeing some fast rotation in terms of liquidity flows, both institutional and retail, which suggests that there could be a pump and dump signal in the short term. Doesn't mean that tech goes away. It remains strong in the medium to long term, but it has a healthy unwind.
Gotcha. Right. Russell?
Well, Russell's the weakest link. I mean, in the Wall Street, Main Street comparison, and that's if you have a live chart, we can look at it.
I'm going to get that up now.
But essentially, just look at Russell as a benchmark for Main Street, and also some of the small to medium cap stocks, which have weaker fundamentals.
It's had a really good run.
It has, not as much, but good run. An early signal beneath that trend line would be one to watch. If it holds, then that run will continue to support stronger breadth in the market, which is the lifeblood of a healthy market. But if you're looking to at least develop a defense strategy, it's good to watch how some of these trend structures hold or break down.
It's also been cited by many clients, because after the show I go and sit on the trading desk, and so it's really good. And also I use the Bloomberg over there, and as I'm using the Bloomberg, I can hear what's going on, you know, when our clients call up, and I hear the conversations between them and the client managers. There is a lot of music around, you know, whether Russell's a good place as a hedge. You know, should there be a froth taken off the market? What are your views on that?
Traditionally, yes, value outperforms growth as a rotational play, but there are exceptions. For example, when we're late cycle, because typically, if volatility is strong, then it's a one size fits all, and that tends to trickle through across the board. But the opportunity is to play it tactically. So I would say, yes, value could outperform, but do be careful with risk-reward trades. Manage it as astutely as possible, just because if there are fast reversals from those setups, it's best not to get caught out. The other thing is you could also look at sectors as a potential way of gauging not just growth value but actual sector play, which can be expressed through ETFs. And that
Which ones do you like as a hedge? I mean, the defensives. Some others I've spoken to have said they've gone into sin stocks. Which ones in particular?
Well, healthcare is unwinding. Utilities is a little bit of a hybrid defense because it has an AI element to it. But certainly it's something we should track. Some of the old patterns in terms of how defense used to play is changing now. So it's something to look at for those who are willing to play sectors.
Any other charts that that you have seen recently that have...
Yeah, so we've covered cross-asset with exception to currencies, and I think it's worth looking at the dollar index.
Okay.
And then community members can draw what they may in terms of trades. Clearly, euro dollar will be an obvious derivation. But just to make the point, objectively and apolitically, because there might be Americans listening in.
We do actually. Yeah, Boston
I'm sure.
Frank.
There we go. And I was just in New York this past summer sharing the global view with the dollar chart, making the point that the dollar has, remains strong in terms of its reserve currency status, but the trend has weakened after a multi-year topping pattern, which broke down formally this year. And that's why we had a 10 to 11% depreciation in the dollar index, which most headline news was saying was the weakest drop in decades. That may be true, and clearly is significant for that reason, but also technically we could see further weakness in the dollar as expressed in the dollar index, and we're seeing this across the board. I mean, this is an expression of more currency majors, so euro, dollar, Japanese yen, pound, we're already seeing some of that. But also, if you look at other indices, perhaps on the Bloomberg terminal, you'll see emerging markets, big trend reversal against the dollar. There's also a commodity story there. If dollar weakens, commodities typically become cheaper. And
so I've got a theory. I'd love for you to poke holes in my theory, because it's based on that. So I think because of the weaker dollar, I love how you say weakening and all that. When I speak to analysts and strategists in the US, they go, it's being trashed, is their technical term.
British diplomacy at its best.
The French language of love, British, the language of diplomacy. So I think copper, for example, maybe next year is the year for copper. given we might see all the tariff issues start to not ebb away, but come to some form of compromise. There is still a huge case for copper, given all the tech and the AI that needs to be built, and the EVs as well. People forget that we do need copper in that area as well. And with the weak dollar, surely this would give its wind in its sails.
Yes, absolutely. So we're super bullish gold.
You can say that's totally rubbish.
Agreed on the commodity story. I'm reluctant to say copper here and now, just because it's been volatile. We had a pop to the upside and then a short-term shakeout following Trump's direct tariff on copper, which created an anomaly event. Copper remains a long-term strategic opportunity, both based on copper fundamentals. You mentioned the EV story as certainly being part of that, but there's an open question as to the pathway between here and then. So the best thing that I would recommend is for people to look at the commodity equity ratio, because that shows a generational rotation ahead, but it hasn't triggered yet. But if you look at commodities year to date, equal weighted, it's double digit. So commodities are an asset class that should really be better recognized. Weighting should be increased, and your IG audience, if they're not trading it, should at least take a look at it. And here and now, I think you just expect rotations. You're going to get early leadership, precious metals, case in point. A lot of people say precious metals, gold, it's not a commodity, it's an asset. But ultimately, if your aim is to make money, then own it.
Yes.
And we are back. This is Overtime. I'm Ilya Spivak in San Francisco. That's Dylan Radigan in Milan, Thomas Westwater in Chicago. We are looking at just a bit over 24 hours after the Fed. The dust is settling. The markets are picking a direction. Gentlemen, what make you of all of this?
I mean, it kind of came in as expected for the most part. The initial reaction was a sell-off. I went ahead and got long when the NASDAQ dipped around 24,400, sold a put spread at 24,000. And I did it in the 1 day, so it worked out there. I think now going forward is a little more uncertainty. You know, Powell stating that both sides of the mandate are potentially can be misaligned going forward this year. I mean, we got the one dissent that was a given for the 50, but I think it's going to be the same story going forward, data dependent. I think it's going to depend on the news. Inflation comes up, you're going to be looking at, more risk in the market. Labor market goes down at the same time. That complicates the Fed's path. So I think we have to take it week by week here, looking at data points, and it might be potentially more volatile going forward.
Yeah, I think so. Let's take a look at the charts here. I think probably the most annoying of the charts for those of us that were short the S&P going into this is this right here. So here's the Fed, and Thomas, to your point, the initial reaction is negative because I think we can surmise here that all of what the signaling was, besides the cut itself, was on the hawkish side of what the markets wanted. And I think you can see that with the naked eye, as it were. I'm just going to see if I have the Fed forecasts here. I do.
What's the alternative to the naked eye?
The eye covered in glasses, I suppose.
Okay.
I suppose, as you see demonstrated here.
I mean, corrected vision might be considered a preferable alternative to the naked eye.
if one needs one's vision corrected. If one's vision does not need correction, then all you see is a blur, and that's a whole other situation. What you can see here clearly is the revisions to GDP growth. They're not down, they're up. They're up for this year, they're up for next year, they're up for the year after. The only revision that you see in the forecast for unemployment next year, the year after, it's for unemployment that's lower, not higher. For inflation, only one adjustment for next year, and it's higher. So the Fed comes out and says, yeah, here's your cut. Whatever. You knew that was coming, but everything else we are going to upgrade to more growth, more inflation, and a better job market. Okay, what about rates? So the baseline here is a little bit different now. The Fed basically says, okay, the market's already priced in 3 cuts. We will endorse this. Congratulations. Even though it was very narrow, by 1 vote. Guess whose vote it was? You see this lonely dot down here?
I do.
Guess who the tiebreaker was?
Can't say.
Yeah, between 2 cuts and 3 for this year. But the market's already had it in the forecast at over 80% for both of those cuts, October and December, a week before this Fed meeting. And you can see it here. So here is, there we go. Here is October. This is a week ago, over 80%. Here's December, a week ago, over 80%. It's not like the markets didn't know that this was going to happen. So, what did the Fed do here? It just acknowledged what the markets already knew, but then still only 1 rate cut for next year, only 1 rate cut for the year after. That's at least 50 basis points removed from where the markets are. So this sounded hawkish. And so the dollar is up, yields are down, or bonds are down rather, yields are up, gold's down. All of those elements of what we'll come to call the Radigan, all of that is still there. I mean, you can clearly see it. Here's gold. It's down. That's not a dovish.
Gotta love the short gold, long dollar, but not satisfied with the Nasdaq's performance as it comes to the Radigan. Speaking.
Well, and this is the interesting thing. So all of the hawkishness here seems to be existing in all the assets except stocks. Stocks seem to have a very different view on all of this. So here's the dollar. It's getting stronger.
Gotta love it.
If you want to look at the dollar index, we can look at an average of the dollar. There it is. It's up.
Gotta love it.
If we wanted to look at what the bonds are doing, bonds are down, yields are up. So I can only surmise that what all of this means is that the markets have looked on upon the Fed's forecasting of faster growth and faster inflation and lower unemployment and said, they have decided that they're not going to continue to try to save the White House from itself. And they're just going to say, you know what? F around and find out. You want to run this economy so hot that inflation kills consumption? Go ahead. Run it hot. See what happens. And stock markets said, okay, I guess we're going to run it hot. I guess growth is going to be faster. I guess inflation is going to be faster. I guess asset valuations on the risk side of things are going to be higher. And so NASDAQ seems to, I mean, we have it here with the naked eye, as it were. It's going up.
I find it agitating and perplexing and somewhat dismaying.
It is all of those things. What it is from a price action perspective is closing above the swing high here, and so making a higher high and basically saying, I'm resuming the trend, I'm going up. Which, interestingly, Thomas, is not what you have in the S&P. You try to make a new high, and then you fail. Does this tell you anything, Thomas, about maybe there's something under the surface here? Maybe the market is still attempting to think about what it thinks of the Fed and still deciding, or have we already decided?
I mean, yeah, staples, discretionaries, energy were the only real three losers today. Technology coming in really strong. I think this is the NASDAQ making new highs is speaking to the economy is going to be run hot. These companies are going to be able to capitalize on that growth better than others. But I mean, the S&P 500 wasn't the vehicle that I wanted to get long in yesterday. It was the NASDAQ. I think that would have had the best reaction. It's been the leader. I think it'll continue to do that. But you also had a lot of strength in the Russell. So, I mean...
You did, yes.
It's, the Russell, a lot of regional banks, of course, it likes lower rates. If you're thinking of a hotly run economy...
This is the run it hot prime example.
This
is like the cyclicalist of the cyclicals.
I mean, it goes back to what I was saying on Tuesday, that the risk isn't in the short term. It's possibly next year when, if you let this economy run hot, the difficulties with the dual mandate that Powell mentioned is going to come in the form of hot inflation and, it's a still weak labor market where those mandates are conflicting and they have to pick one to address. So for the time being, they're focused on labor. Of course, that the labor market got weaker and we got the cuts. Inflation is still above target. So I mean, it's next year, I think, where the real risk comes. And I think the market is going to continue to just grind higher for at least a few months. I mean, the rate cuts are here, they're coming, but what comes after that? What are the consequences of once these rate cuts start to bake into the economy next year? So the way I'm going to be playing this is taking my shots on the long side. On dips, I'm going to be selling put spreads and mainly playing it through that, giving myself a little bit room on the other side, doing it with short-term expirations, possibly as low as 1 or 0 days. And, I've done that in and out over the past few months. It's worked. I'm going to continue to do that.
Yeah, I mean, it's a very interesting thing here. Now, are you going to, in making the assessment that, okay, you know what, they're going to run this thing hot, it's going higher until it isn't, who knows where it ultimately wipes out? It will wipe out eventually, but this is not where that is, apparently. So how do you structure that then? Are you shortening duration or extending duration? Are you saying I'm gonna approach this in the Russell, or you're gonna stay in the NASDAQ? Are you picking individual days?
I'm going to stay in the NASDAQ, and the reason I'm doing short duration, which isn't like I do in other assets,
right,
is because you get these big moves up after these dips, and the moves higher are pretty quick off these dips, so they get bought up quick. And if you could get in and out of these positions, without waiting weeks to take it off, I think that's the way to go. It's like I said, it's been working for me, so I'm going to continue to do what's working.
It makes sense to essentially say, well, you know what? I'm not going to make a great big bet on what the trend is. I'm just going to make a bet that the market at this point is so conditioned to buying the dip that even if eventually it's wrong, you'll get that initial rip from a dip. And if ultimately you get the big one, it'll be after some initial reaction, and hopefully you're already out of there by then.
Yeah, and I mean, the labor market's interesting right now. It's like, we don't have hiring, but we don't have many layoffs yet. It's kind of stagnant. Right. It's stagnating. And, is one cut going to inspire enough confidence in these companies to start hiring right away? Probably not. I mean, so we're probably going to see the labor market continue to not drop off a cliff, but just continue to stagnate. So, I mean, once you get 3 or 4 rate cuts in and you get the labor market starting to recover with inflation already above target, then there's more demand in the economy, more people with jobs. What happens to inflation then? I'm presuming that inflation is not going to get down to target, and next year we're going to see it start to rise more. And there's arguments, have the inflation impacts been baked into prices all the way? I don't think necessarily yet. I think that's going to take some more time. But I think the risk to the market in terms of headlines and, trade war headlines, I think that's largely off the table for now. So I think it's going to be something that, we're trading less headlines going forward, and we're trading more data.
It certainly seems like the game now, to your point, is, okay, we're going to run this thing hot until the heat of the inflation starts to really beat down consumers. And we already have this weakness, Powell talked about it, in what happened with consumption in the first 6 months of the year. It was a terrible 6 months for consumption, the worst in 5 years. 5 years before this year, of course, was the COVID lockdown. So not a happy reference point. So we already had weak consumption. If we look at face value, let's say the retail sales numbers this week, they were fairly okay. Mostly because of e-commerce, mostly because of purchasing upmarket. But down market, there's a lot of strain. And we can see that, we can certainly imagine that by the time we get to third quarter GDP data, those consumption numbers are going to look weakish, and then going into the fourth quarter, weak, because all of that inflation really starts to build in its cumulative effects. The goods inflation side, and again, Powell talked about this in the press conference and pointed out goods inflation, as we've been pointing out, is at the highest in 2 years. And that's not negligible. That's not normal. So you have a situation where ostensibly this will come together to crash growth and basically overheat the economy eventually. But the question is, when does eventually come? And in the meantime, you're basically one bad data point away from saying, oh, we've arrived. Here is eventually. But until you get there, you don't really have any reason to think that you finally had one shot too many, as it were. It's one of those things where you know the line when you cross it.
Yeah, I agree. And I mean, you look at regional banks, they did really well today. Of course, they like those rate cuts. But I still think there's two different economies right now in America. And I think that's why technology has done so well. There's still investment. There's still capital spending. I mean, there's still a lot of this AI hype. And, I was a little surprised to see the Russell perform so strongly today. And I think it's the banks that are reacting to that. I think without the banks, the Russell wouldn't have made that move. But I mean, it's
probably not.
It's, I have less confidence in the Russell going forward than I do in the NASDAQ. So, I mean, I look at the Russell, but I don't trade it.
Yeah, I mean, if we look at where we did the best here, just looking at one-day performance, I mean, obviously, tech absolutely killed it, and all of the weakness today seems to be on the defensive side of things. But it isn't just consumer defensive that had a big hit to performance. It's also consumer cyclical. It's also energy, which is interesting in the in context here, because it does seem like the market recognizes that running it hot is not a good idea, but also that things like tech aren't so cyclical, and until there is a real hit to underlying demand, they can just run for no reason other than there isn't a bad reason. Which is a kind of it's a kind of crazy thing. Is there anything that interests you, gentlemen, on the bond side of things? Because this now is a very curious chart, and what I'm seeing here is a trend that's going up, a pullback into former resistance turned support, and a sense that if the Fed is really of a mind to cut rates, but it's not going to go big now because it hasn't seen sort of the boogeyman of growth here. It's upgrading its forecasts and whatnot. That this means that rate cuts are going to keep getting pushed out, and so the yield curve maybe twists, and so you get fewer cuts up front, but more of them later, and maybe this is a buying opportunity.
Yeah, I think this is a buy when ZB drops just a little bit more. I have it marked as the 21-day EMA, which is right under where the lows of the day were today. I almost bought there. I held off on it. I mean, you look at this compared to June. So the median expectation for the rest of the year is 2 cuts, but you had 5 or 6 policymakers, say no more cuts this year. So the market got really priced into this rate cut that happened this week. But I think there's less certainty on rate cuts happening this year. We know they're coming. We just know whether they're this year or next year. I think that's going to depend on a lot of jobs numbers over the next couple months. But it looks like they're getting pushed out a little bit, which explains, the rise in yields a little bit here. But still, they're coming. And, I don't think the bond market is fully priced in. I think we still have more room to run higher with cuts eventually coming, whether they're, in a few months or 4, 5, 6 months. So I do think that there's more upside, room for bonds to run.
Dylan, can I get you into a long bond?
Not in a million years. My only relative position compared as it relates to the macro economy and the sort of most macro sense of the word is in that long dollar position. And by virtue of being long dollar, I'm short marginal expectations of rate cuts, which I guess would put me into some version of a short bond-ish position, I guess. But I wouldn't put myself there. I like my long dollar, not just on the absence of rate cuts on a relative basis, absence of a marginal rate cut, I guess, combined with the abomination that has been the Trump attack upon the dollar. And so I've sort of let my bond position reside inside of the US currency without actually expressing it in the bond market explicitly, because I don't have the confidence to be long or short the bond on a fundamental level. Or I guess by virtue of being long the dollar, I'm short the bond on some derivative basis.
I suppose so. If you think that the dollar is being driven by higher yields, I wonder if...
Which I don't.
Right. So I wonder if there's a difference here, to Thomas's point, between what's going on at the front end of the curve and at the long end. So the way I structured this, and you can see that I have this on as of today, is through TLT, where you can see IV rank is only 4. So if ever there was cheap vol to buy, I mean, this is pennies. And so if you look at sort of where you are and you just say, you know what, if I did an at the money call vertical here, basically from where we are, 89, out to the next big pocket of liquidity, which you can see here. Obviously, there's some liquidity here, but the real meat is at 95, which not a shocker, really. That's right above here, above this swing high and into these tops. So 95 is just about here. So if you wanted to take the trip from here, where let's say this was the top of the range and you've pulled back into it, from here up to essentially a retest of whatever top this is, this high and that, somewhere in here, the risk reward on it is pretty incredible. I mean, at 168 to 432 max profit, you're talking about basically 2.5 to 1 risk reward because vol is so cheap. It's not a bad idea in my mind. And so I've put this on just as a trade, not because I terribly believe in the idea, but because the risk reward is so good and the vol is so cheap, and I can think of how this would work and why. Seems to be something to consider, and so I have it on now. I suppose if we're going to run this thing hot, then the place it should show up first and foremost is higher rates here. This is ZT, and you can kind of see it. It's sort of there. The move is there. We're kind of testing into here, and here's the continuous contract. You can see it a little bit cleaner. I wouldn't say it's a done deal that bonds are done going up here, but it does seem a little bit heavy. Whereas if you look at ZB, I think maybe on reflection, it makes more sense for this to be a pullback in a move higher than it does at the front end, especially if the Fed is going to be cagey about cuts next year.
I mean, do you have a strong bond position on beyond a marginal position? Are you prepared to put a meaningful capital behind a bond position? Are you, Thomas?
I'm not a meaningful position.
I'm not in a bond position right now.
Exactly. Are you in a dollar position, Thomas?
I'm short the Canadian dollar.
So you're long the US dollar by virtue of that.
Yeah, right.
Mm-hmm. Short gold?
Long gold.
Mm-hmm. Mm-hmm.
Long gold.
Point is, there's nothing in the bond that attracts you to a strong position. Anybody.
Not yet.
Because who could know? Who could know? You got these rate cuts, but you have this sort of weird marginal increase in inflation, weird marginal increase in growth, bizarre super records in equities in the face of slowing growth and inflation, oddly weak dollar, which I think is the only reason the stock market's at records, because it's a dollar adjusted number.
Very well could be.
And I would think a stronger dollar ultimately means a weaker. I mean, that's why I like my short NASDAQ, long dollar, short gold. Although, why are you long gold, Thomas, at this level? Out of curiosity.
I'm just playing. So my gold position is for 40 days out. I kind of had it on to hedge uncertainty going through this. Obviously that's not working out today. But I just think ultimately gold makes a move higher as we go into some of this uncertainty into that year with deficits, things like that. It's just something I've been doing that's been working out all year. Buying either gold or silver. I mean, I've been switching between those depending on technical levels, but just staying long the metals in one form or fashion.
Has been your friend.
It's been friendly.
You're saying it's habitual.
Yeah. I'm doing that through long call spreads because usually we see volatility expand when gold moves up. I mean, I don't think we got that on the last move higher. The first time it, hasn't had that correlation with volatility in quite a while. So I'm not sure what that tells us. I'm not sure if that's a sign that, this gold move is ultimately maybe have topped somewhat. But I still have enough confidence. It would take a much larger pullback, somewhere under 35, for me to, really abandon a bullish thesis on gold. I mean, the dollar, I do think the dollar is a threat.
Meaning a stronger dollar creates weaker everything.
Right, right.
Yes. Yes. It's an interesting thing here because if you look at what gold's done, it pulled back. It's not in the strictest of terms breaking down. So if this was kind of your line in the sand right here, you're sort of at it. So right here is your kind of range bottom, as it were, on where kind of the base for gold was. Now, Dylan, to your point, this is not it's not lost on me that this was the top of this range. You came and tested that right here, held it, then broke down. So we did take a step lower. I mean, that much is clear. There was a range here, it held, we tested it, we broke down, we took a step lower. But this now is perhaps a more meaningful sort of level. And I haven't gotten out of my long position yet, not because I don't agree with where you are on this. I actually do. I need to see this thing show me.
You want a little confirmation, as they say in the business.
That's right. I'd like to get it under here, and then I'm out. I've made my money, thank you very much. And it's the same thing in silver. So if you look at silver here, very, very similar setup. So if you look at kind of where the logical, that's not it whatsoever. There's absolutely nothing logical about that line. If you look at what is in fact a logical line, let's say here somewhere, then we're kind of at this interesting bottom again. And it's the same thing as gold, where you had this range top, you are through it here, and you did hold it. I mean, like, this is pretty technically clean. You break down, retest, nope, retest, nope. Okay, now we're going down. You might even say there's a little give here, maybe something like this. But again, you're resolving lower. But this is an interesting sort of line in the sand here. So I'm still long this because Chris talked me into it, but I'm okay to hold it probably unless it gets down here. If it breaks down here, then the trade's wrong and I'm out. And I'm happy that I'm long dollars on the other side, because if the trade is wrong, then ostensibly the long dollar move will keep going and that'll be an offset.
I mean, don't you think generally it's well advised to blame any losing position on Chris at this point in time?
Absolutely.
Considering his,
if it's not working, the mere fact that he's not here to defend himself means that it is his fault.
I would agree with that.
I mean, for gold, you still have a lot of things that have been in place driving it higher that haven't really changed.
That aren't the Fed, yeah.
Right. I mean, central banks, they were big buyers of gold in 2024. It's kind of slowed recently, but they're still buying. I mean, the war in Ukraine, it doesn't look like they're making really any progress. I mean, I think that's putting a little bit of a premium on gold. Say you get some breakthrough peace negotiation. I think that's something that could, actually cause a larger pullback for the time being. But I mean, outside of that, there's still fiscal uncertainty. There's uncertainty with the Fed's independence. There's now more political uncertainty. I just don't see the trend really reversing without some potent driver that comes into the market.
Yeah. I mean, one thing that sort of sticks out for me, next week we're going to have the first look at S&P Global PMI data. And it's not the kind of loud release that a CPI number is, or NFP, or a Fed policy announcement, yada, yada, yada. But it is a very timely look at essentially where the dynamics of growth are. And the expectation, if we look at what the markets are looking for here, I mean, let's set the stage here first. Last go round, they showed that the US economy is reheating. That essentially we're starting to get positive momentum back into the economy. And we see here, let's see if I can get this on the screen. There we go. So here's the US composite PMI. I mean, we can see where the weakness is around the tariffs. And we can see that over July and August, the economy seems to be reheating back to levels that we saw at the end of last year, which is pretty heady in context. I mean, you can see end of last year was some of the highest we've seen in a few years. So looking at this should be interesting. The expectation is that there's going to be a little bit of a cool down. Do you think if we get a meaningful decline and all of a sudden the economy is like, whoa, 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 these concerns that the Fed might have about a shifting of the scales is coming together quickly? Is that fast enough, Thomas, do you think, to short circuit this run it hot idea, or are we going to need to see something of greater substance?
I think you need to see a little more than that. So I mean, a lot of the weakness has been companies are they're facing uncertainty. They're not necessarily investing less. They're doing stuff to control costs. Like one of the first things you do is, you stop hiring, potentially lay off some people. But you don't necessarily stop investing in your core products or whatever you're selling unless demand drops off, right?
Right.
So if it depends what the numbers are driven by, right? If there's all of a sudden, more weakness in the labor market to which degree that demand starts dropping for services, which is the majority of the US economy, then I think that's where you get a little bit more concern. And I think you'd see a lot more volatility if that was the case. If it's a gradual decline, something that's, it's not going to head us into recession, but there's some weakness, it gives the Fed a little bit more appetite to pull those rate cuts back forward. I think the market would potentially rally on that.
Dylan, thoughts?
You're saying, Thomas, the market would rally on what?
So if these PMI numbers drop considerably, it would depend on what they're dropping on. Is it some weakness in hiring, some slowdowns in orders, but the actual demand in the economy isn't dropping off? I think that would push up the rate cut bets or pull them back forward to where we get maybe 3 rate cuts this year. I think the market would rally on that. I think where it comes into a problem for the market, equity markets, is if you see this dramatic decline where you're getting layoffs with a drop in demand, and then you're expecting corporate profits to cool down a lot, then I think you start getting a lot more weakness showing through. I don't think that's the scenario we're going to see. I think the economy is going to remain.
You're saying that's a prerequisite to my NASDAQ sell-off?
Yeah, one potential.
Speculatively.
One potential, yeah.
So to that end, here's the GDP Now model from the Atlanta Fed. And again, we're far enough removed from these third quarter GDP numbers that the actual number that this talks about, which is a 3.3% quarter, is meaningless. We're too far away. But the slope of that green line does matter in the sense that it gives you a sense of what kind of data is going into the model. Because we just had a model update today. for example, with the jobless claims numbers and everything else that came out. The slope is up. So as you get more and more data coming in, I mean, sometimes this thing is revised daily, sometimes every other day, depending on kind of when the relevant data comes out. But it's revised in real time, as it were. And so you get a sense for the tone of the data going into the bucket. And the slope of the green line tells you the data is growth positive, at least as far as this bucket is concerned. And so if that's what it is, then it would stand to reason that at least for now, the market isn't getting the evidence that whenever eventually is, whenever sort of the overheat comes, that's now or that's here. You'd have to start to see some kind of substantive growth scare occurring for the markets to go, oh, wait, this is not that. And then maybe things really start to get unglued, at least in stocks. But in the meantime, it doesn't seem like there's anything that necessarily speaks that way. And it sort of makes you think that, yeah, maybe the metals haven't broken down yet, but if we're wrong about yields, if yields are going to keep going up, if essentially this idea that this is some kind of a thing to buy is wrong, and it turns out that actually yields keep going higher because we are going to run it hot, then it could be that at least two legs of the Radigan are already working and will continue to work. That is to say, metals will go down, the dollar will keep going higher.
The problem with the Radigan, as it were, is by virtue of the probably illusory and misguided validation of being right on the dollar and gold, at least for the day, is it lends me to the delusional belief that the NASDAQ must come around, which obviously it has no obligations to oblige itself to my madness. And so I'm not entirely certain as to what to do other than the fact to be satisfied with my long dollar, certainly dollar euro, which is kind of where I've positioned myself, my short gold by virtue of the GLD put spreads, and then my less satisfying short triple Q, which is obviously underwater after today's adverse reaction to my advocacy for its decline. I guess my point is it's sort of a trading lesson in the sense that just because you're right on, let's say I have three ideas, right? Short NASDAQ, short gold, long dollar. Mm-hmm. Just because you're right on two of the three ideas doesn't actually mean that the third idea will eventually be right. In fact, you could be so wrong on the third idea that your rightness on the other two ideas could be rendered financially immaterial, which I'm fearful may in fact occur.
Well, indeed. I think I have been lucky in the sense that my idea since the beginning of the year, sort of in the first 6 months of the year, my idea was short dollar, short stocks, and obviously short dollar worked and short stocks didn't. And thankfully, I made more on the dollar idea than I lost on the stocks idea. My idea from the middle of the year up through about now was long the dollar, long bonds, short stocks. And again, short stocks obviously didn't work, but long bonds did. And the dollar did start to bottom in July and hasn't overcome those lows. In fact, it seems to be going up again now. So that's offset my sins in the stock market. But that's not at all a given. You can absolutely lose more on the side that isn't working. And especially in a market that refuses to go down almost constitutionally and just does not want to give up but for some sort of obvious Armageddon-like scenario. Thomas, while we have you here, our resident commodities expert, what do you make of what's going on in oil here, if anything? I think one of the interesting sort of things on the board here continues to be this sort of stubborn standstill for oil. We talked about maybe it was attempting to get higher here. It found familiar resistance again, and so it's getting wedged back in. Do you think run it hot ultimately means a kind of cyclical oil rally, or this thing is just fairly valued and isn't going anywhere?
I still have my iron condor on. I'm going to continue to do that. I mean, it's worked all the way since June, you know. So I think it's going to keep working. You have conflicting factors. Crude oil stocks did decrease, you know, last week. We got a little bit of a rally from that this week. You know, we had the Ukraine drones attacking Russian export terminals and things like that. So I don't know. I think oil is kind of locked where it is without a signal that the economy is either going to fall off a cliff or go into, you know, a super strong part of the year. I don't really see much happening with oil. I just, you know, global inventories are rising. OPEC's going to be pumping more oil. At the same time, Russia's going to be exporting less. So I'm just playing the range right here. I'm going to continue to play the range. I think where you get a little defensive is where you get, you know, up around the recent swing highs and swing lows for oil. And, you know, that would be down under 60 or above 70. I think as long as you stay in there, I think it continues to trade in a range.
Before we call it a day here, one thing I wanted to take a look at is actually the Swiss franc, which is a recent addition on our futures menu here. And in particular, see if we can get the continuous contract. Here we go. So if you were going to play a dollar reversal higher, this is maybe one of the more interesting spots. So you had this attempted breakout, which has now failed. And not only has it failed, but it's failed in kind of semi-spectacular fashion. If you're a fan of candlestick patterns, that's a bearish one. And so if you were going to take a bet to essentially say, okay, maybe there's rate cuts in the US, but the dollar is clearly not correctly valued here, at least as far as the markets are saying, because the Fed was not as dovish as the markets thought. So maybe it's got room to recover, and it seems to be making inroads already. And looks a little bit more convincing than some of these other ones. I mean, the pound looks not bad. The Aussie looks not bad. Thomas, can I get you into a Swiss franc short position? Dylan, can I get you into a Swiss franc short?
Meaning a long dollar position versus the franc at the end of the day.
Correct.
Thomas, go first here. I'm up because my whole relationship is euro dollar, maybe yen dollar. I wouldn't even know where to begin to establish an opinion on the Swiss franc, other than they do have a lovely set of mountains and lakes.
And in fairness, it's very euro correlated. So what there is in the euro is very often the same thing as what.
And so I'm happy to be short the euro and not get myself mixed up with these mountain people.
Ilya, when I started working here, I was told not to trade the Swiss franc, and I haven't really
so
done
you
that.
Continue.
So you know,
why were you told that, Thomas?
There was a couple people working here recently that were kind of burnt on that that whole revaluing of the franc a while ago.
Ah, yes.
Yeah.
God, I'm happy.
I think some unspoken individuals with a deal gone bad.
Yeah. So I've heeded that advice. I don't know. I mean, the franc, it's interesting to look at, but I haven't had really any appetite to trade it. When I'm trading the dollar, I usually do the euro, the yen, one of the majors, the Canadian dollar, the Aussie. So I stick there.
Why are you trying to suck us into your Swiss franc situation, Ilya?
Well, it's funny because I can say with some certainty that part of this amorphous group that Thomas is describing includes me. I mean, I was one of the people, surely, Thomas.
You're one of the individuals.
Yes, that forewarned against the shocking actions that the Swiss National Bank likes to take, and sort of the tender miseries of having your central bank be a publicly traded corporation and operate from that perspective rather than a central bank as such. And so the kind of decision making you get out of them is sometimes not what you would expect a central bank to do. Hence the catastrophic reval of Euro Swiss in 2015, which ripped many a face off in front of my very eyes. Thankfully, I had no involvement in that idea whatsoever. But it's certainly...
Well, what brings you to the Swiss francery today, if I might be so bold as to ask?
What brings me to it here is it seems like the Swiss National Bank isn't a factor here, that this is just a reflection on the dollar is undervalued, and one could have a dollar trade here that's not mixed up in any kind of European geopolitical what have you, and is just the dollar play in a naked way.
Would you rather be short Swiss franc as a dollar long, or like why establish a preference to be long the dollar v franc versus v euro, v yen, v?
Oh, I'm short those two. I'm short those two. I think here the technicals are maybe a little bit cleaner, but that's about it. I mean, let's compare this with the yen, which is another thing I'm short. But this looks more like a range within which we still exist. And it's not quite as convincing, although being short the yen, I think, is a trade. I mean, it's a trade I have on. Interestingly, I have it on here on the tastyfx side in spot. You can see here it's making a little bit of a profit so far, because the 6J future, I think, is just way too big. And so I'm doing it in spot because it allows me a 10K lot position. It's smaller and more manageable that way. I might consider the same thing for Swiss franc, where I might put it on the spot side, and in doing that, kind of dilute various S&B shenanigans risk.
There's an important election coming up for Japan in October.
There is.
The one person that's running, I can't pronounce her name, is a big proponent of ultra loose monetary policy, right?
Yes. There seems to be an interesting situation going on in Japan, and we'll no doubt talk about it next week. I'll just leave us with this idea that there does seem to be something like a trend emerging here for the yen, whereby the highs are getting lower, the lows are getting lower, and one might think that the path of least resistance is this way. But with that, overtime is out of time, so we're going to have to get to that later. Thank you, as always, gentlemen. This is our last moment together for this week for overtime, but I'll be right back for macro money, where we'll continue to pick apart where the dust is settling after this FOMC announcement, and I will see the both of you on Monday when we return. first 24 hours after the Federal Reserve policy announcement have elapsed, and price action seems to be picking some directions. And what it suggests is a bit of a regime change for the markets. We're going to explore that here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And we're going to take a look at what these markets are doing with this Fed announcement, because it does seem to be something of a change of pace with where the markets have been for the past several months. And see if we can't unpick what all of this gyrating means for not just what's happening in the near term, but perhaps for the path forward and the recalibration, as it were, of the market's lens through which it receives economic data and other news, of course, and what the reaction function is going to look like from here, as different from how it's worked before. So first and foremost, let's take a look at how the markets performed today. We can see it was decidedly a risk-on kind of market. Looking at Wall Street, S&P 500 up 0.6%, NASDAQ up just over 1%. Yields, however, higher. Gold lower. The dollar higher. Bitcoin doing its stocks plus a high beta volatility premium kind of thing, where it's risk appetite with steroids, basically mirroring what stocks are doing direction-wise, but with a bigger swing. So what's interesting about this, of course, is one might have expected that if the markets wanted a dovish Fed, either stocks would be down and everything else would be as it is, or stocks are up and you'd see yields are lower, you'd see the dollar is weaker, you'd see gold is up. That is not clearly what's going on here. It is much more so what happened in the initial reaction. This is how markets closed yesterday. And we can see yields are up, gold is down, dollar is up, the euro is down about 0.3% here, as is the yen. Stocks are soggy. They're not nearly as bad as they were, as we discussed yesterday, with the initial post-Fed spike down, but they ultimately closed with some weakness. S&P off 0.13%, NASDAQ off almost 0.25%, yields up by a good margin. So just looking at the price action here, we can see the markets read the Fed as relatively hawkish compared to what it wanted. And today we see a change of pace. And it's stock markets that diverge. Yields are still going up, as they did yesterday. Gold is still going down, as it did yesterday. The dollar is still going up, as yesterday. The difference is sentiment. And not just, by the way, in stocks. Bitcoin, again, as a kind of avatar for sentiment on steroids, or risk appetite on steroids, same thing. Yesterday, stocks down, Bitcoin down. Today, both up. So what's the stock market telling us here, and why is it sort of changing its mind about its relationship with Fed policy expectations? Well, let's look at the statement here first. We can see some of the changes marked off here. Hat tip to Nick Timmeros there at the Wall Street Journal for this handy vision of the things that were adjusted. We can see some of the key things here are that recent indicators suggest that economic activity has moderated. Job gains have slowed. The unemployment rate has edged up. So clearly we can see where the justification for the rate cut is coming from here. The committee is attentive to the risks to both sides of its dual mandate and judges that downside risks to employment have risen. That's ostensibly where we get this rate cut. In support of the goals and in light of the shift in the balance of risks, we get the cut. And indeed, if we look at how Fed Chair Powell characterized this, we can see we get the same nod to slowing in the labor market and the shifting balance of risks, and then an explanation that tells us we're not worried or anything. This is a risk management cut, whereby the scales have tilted somewhat, and so we are going to make a small adjustment to reweigh our stance relative to the scales. Where if we have inflation and employment on the scales, then if they were tilted totally toward a focus on inflation and no focus on the labor market, now they've shifted a little bit in the direction of the labor market, and that's what we're going to do. Notice the comment here, Powell saying, I don't think we can say that policy no longer warrants a restrictive setting. That is to say, the Fed, and Powell, as speaking for the Fed, still thinks that monetary policy needs to be somewhat restrictive, despite the weakness in the labor market. And that, of course, reflects inflation that's at a 7-month high. Last we checked in on CPI last week, and where goods inflation is at the highest in 2 years. Thank you, tariffs. However, we do get the sense that we still are working on the assumption, looking at what Fed Chair Powell is saying here, that the tariffs are going to be a short-lived thing, and so we get this maintenance move. Now, where things get really interesting is in the forecasting, because for a central bank that's cutting rates and saying it's going to keep cutting them, the adjustment in the forecasting is pretty hawkish, again, in relative terms. So growth expectations are revised higher here for all 3 years of the forecast, for which we have a June baseline. The unemployment rate, steady for this year, but for next and for 2027, revised lower. Inflation, mostly steady, but where there are revisions, they are revisions higher. And for the rates path, we do get a third cut that's baked in for this year, but still from, admittedly, that lower baseline, so not 3.9, which would be June's projection of 50 basis points in cuts this year, from 4.4 down. Now we're saying 3.6, but thereafter, still only one cut for next year, still only one cut for 2027. Now, how you arrive at 3 rate cuts here is a bit of a subject of its own debate. You can see here, there's an even split here almost between those people favoring 2 cuts or less, and those people favoring 3 cuts or more. And obviously, you get a very dramatic skew in the forecast here with this dot. We can surmise who that dot might be. But when we look at this, nevertheless, we get the 3 cuts, and they don't really surprise anyone because, as we've discussed before, the markets were already set for 3 rate cuts at least a week before this meeting. You can see that in the expectations. Here's the outlook for October's meeting. Right here is the week before today. So a week in advance of the Fed policy announcement, the probability of that second cut at that meeting is already over 80%. If we look at December, a little bit narrower, but again, the probability of a December cut after a September one, after an October one, over 80%. So really all the Fed has done here in saying, oh, there's going to be an extra cut, is give its blessing, as it were, for what the markets already anticipated. But the disconnect for 2026, the disconnect for 2027, that remains. And interestingly, what the markets have done is a kind of curious shift. So take a look now, and we see that for the rest of this year, this is from now through year end, we've got 37 basis points on the menu. So at least one more cut, and as we see, we're erring in the direction of a third as we just looked. For next year, we've come down somewhat, and now we're at 66 basis points. So obviously this reflects the 25 basis point move that we've already had, but notice from the kind of dovish outlook extreme that we had before the Fed announcement, which was 140 basis points in cuts between where we were prior to this week's meeting and the end of 2026, we are now at 100 basis points, give or take. In other words, we've moved more than just the 25 basis point cut. The outlook has become pointedly less dovish for next year. Now, it's still well in excess of what the Fed has, but the market clearly took a cue here and said, oh, so you're saying we're going to have hotter growth, hotter inflation, lower unemployment, and you're saying that means only one cut next year and one cut the year after. We think that sounds hawkish. We still think you're going to need at least 2 cuts next year, but at least directionally, the adjustment that has to happen here is toward a hotter economy. And so the relationship between stock markets and the Fed outlook seems to be in flux. Now, we've talked about this evolution since the beginning of the year, and perhaps we're at another one of these inflection points. We started the year with a growth scare. We can see this right here in mid-February. Stocks reach a top right there. So do Fed policy expectations. They hit a top of sorts. This is the least dovish of this year as far as the outlook for 2025 through end of 2026. Then we get this growth scare around the initial rollout of the tariffs until, of course, there's something of a crescendo with Liberation Day in early April right here, and both stocks and policy expectations hit a dovish extreme and start to correct. Now, by mid-May, the policy outlook is done correcting, and stocks have conveniently come back to basically the spot where the breakout right here starts to actually occur. And so they've erased all of this scare. And from there, so from here onward, it looks like stocks are rallying as the outlook for policy gets more and more dovish. And so it's very compelling to say, well, the reason stocks are rallying, and indeed we said this here, the reason stocks are rallying, or at least in part the reason stocks are rallying, is because the markets are betting that there's going to be cheap money that's coming down ahead. And what that's going to do is, obviously, make assets more attractive, because whatever risks there may be, they are eminently more digestible with cheap money versus not. And so what we see now is apparently this relationship has changed, where this right here is our most recent dovish extreme. And as we saw, again, looking over here, we can see the change here has been greater than just 25 basis points. The change has been essentially closer to 40. And so it isn't just that one cut has already occurred to move this line up. It's also that the outlook for next year has become less dovish. And so what you then end up with now is stocks going higher at the same time that the policy outlook is getting less dovish. And what that seems to suggest is that after the Fed, the markets have reconsidered this relationship. Pointedly, they've not reconsidered it with the dollar, where the dollar has essentially shown itself to be probably right going all the way back to early July, where you can see here the dollar starts to bottom while the policy outlook still gets more dovish, and it seems to be holding that bottom here as the policy outlook has started to shift the other way. And so a turn in the dollar certainly seems to be a compelling idea. And again, over the course of the past 2 days, here's the initial response from markets. Stronger dollar. Here's the follow-on, even stronger dollar. And so it does seem like at least here things are working as you might expect. But stocks have apparently decided, well, we're going to run it hot. The economy is just going to have to get more inflationary. Because clearly the Fed is easing into a situation where it is saying we're going to have faster growth, we're going to have higher inflation, we're going to have a lower unemployment. So we're going to let inflation stay elevated, as it were, at least until it starts to meaningfully hurt consumption and meaningfully show up in growth data such that we know, oh, okay, we're already on the other side of this thing. But in the meantime, stocks apparently are saying, well, if the Fed is going to run it hot, then so it is. And the relationship between stocks and the policy outlook needs to change. Now, maybe this is going to evolve again. We still have a huge triple witching event tomorrow, tons of option expiries, tons of contract rollovers. And so maybe we still need another 24 hours for the dust to really settle in earnest before the end of the week. And maybe this is going to change for next week. But for the moment, at least, it looks like there is a meaningful difference now. And for what it's worth, looking at the way that the U.S. economy has been performing, it does portend some sort of a reheating. Looking here at the Atlanta Fed's GDP Now model, it is surely too early to make much of it as far as the actual forecast for the third quarter. Those numbers aren't going to be coming out for quite a while. So that this model currently calls for a 3.3% annualized rise in GDP for the third quarter. That doesn't mean much of anything at the moment. But that this is a nowcast, that is to say, it's adjusted in almost real time with incoming economic data, that's telling, because we can see this green line that approximates the GDP forecast is very pointedly sloped from the lower right, or from the lower left rather, to the upper right. That is to say, it's pointed up. The tone of the economic data getting fed into this model clearly seems to be growth positive based on what is going on here. And so with that in mind, the market can basically presume that things are going to get run hot until they're not. And for the moment, we don't have the kind of weighty economic data on the menu that would say, oh, here is a meaningful risk. Now, we're going to have the S&P Global PMI numbers next week. That'll be an interesting view on growth. We'll see what that looks like. But otherwise, next week's U.S. economic calendar is kind of soggy. There's really not a whole lot that's there. There's some home sales numbers. There's a revision of second quarter GDP data, just to give you a sense for how far behind that data is and how slowly it's going to take us to get to looking at the third quarter numbers. Not until Friday next week, when we get the PCE report, are we going to get something really meaty for this U.S. growth outlook. And we're going to have to go into the beginning of the following week, as we start to look at the first kind of days of October, when we're going to get ISM data again, we're going to get NFP data again, and that'll maybe give us a different perspective. But for the moment, the Fed's sort of asserting of a hotter economy seems to make sense. And stocks seem to have concluded that with that in mind, they're just going to change the way that they behave relative to Fed easing. And they're going to read the absence of conviction on that easing not as a bad thing, but as indicative of an economy that doesn't need it. And that seems to have imbued stock markets with fresh strength. Now, positioning wise, I am compelled by the price action to stay a little bit short the S&P because it did not clear its swing high from 2 days ago, despite the gains. So I am begrudgingly holding this until tomorrow to see what happens, because it failed to hold above that high today. I am similarly still long the metals, because despite them being weaker, they haven't crossed their Rubicon yet. They're still within their congestion range. But I have also loaded up on dollar longs. So yesterday I was a bit straddling the fence here, short the euro but long the pound. After this Fed announcement, I flipped the pound position over. I am now short. I am also now short the Aussie dollar, short the Canadian dollar, and looking for a bigger dollar bottom to take hold. I also nibbled a little bit on the long side of bonds, thinking that if the market is going to start to think that whatever rate cuts and whatever overheating and growth reckoning might come will give us rate cuts just later in size, then perhaps we're due for a little bit of a twist in the yield curve, where yields stay relatively anchored at the long end, but maybe rise up a little bit at the front end. So because the volatility here was dirt cheap with 4.3 IVR, I took a little bit of a stab at trying to pick a bottom in the bonds and see if maybe that is a part of this run it hot until you can't kind of narrative. And that is macro money for today, as well as for this week. We're here Monday through Thursday, so we'll be back with you on Monday. In the meantime, I'm also writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money returns on Monday. Happy trading. And we are back. This is Overtime. I'm Ilya Spivak in San Francisco. That's Dylan Radigan in Milan, Thomas Westwater in Chicago. We are looking at just a bit over 24 hours after the Fed. The dust is settling. The markets are picking a direction. Gentlemen, what make you of all of this?
I mean, it kind of came in as expected for the most part. The initial reaction was a sell-off. I went ahead and got long when the NASDAQ dipped around 24,400, sold a put spread at 24,000. And I did it in the 1 day, so it worked out there. I think now going forward is a little more uncertainty. You know, Powell stating that both sides of the mandate are potentially can be misaligned going forward this year. I mean, we got the one dissent. That was a given for the 50. But I think it's going to be the same story going forward, data dependent. I think it's going to depend on the news. Inflation comes up, you're going to be looking at, more risk in the market. Labor market goes down at the same time. That complicates the Fed's path. So I think we have to take it week by week here, looking at data points, and it might be potentially more volatile going forward.
Yeah, I think so. Let's take a look at the charts here. I think probably the most annoying of the charts for those of us that were short the S&P going into this is this right here. So here's the Fed, and Thomas, to your point, the initial reaction is negative because I think we can surmise here that all of what the signaling was besides the cut itself was on the hawkish side of what the markets wanted. And I think you can see that with the naked eye, as it were. I'm just going to see if I have the Fed forecasts here. I do.
What's the alternative to the naked eye?
The eye covered in glasses, I suppose.
Okay.
I suppose, as you see demonstrated here.
I mean, corrected vision might be considered a preferable alternative to the naked eye.
If one needs one's vision corrected. If one's vision does not need correction, then all you see is a blur, and that's a whole other situation. What you can see here clearly is the revisions to GDP growth. They're not down, they're up. They're up for this year, they're up for next year, they're up for the year after. The only revision that you see in the forecast for unemployment next year, the year after, it's for unemployment that's lower, not higher. For inflation, only one adjustment for next year, and it's higher. So the Fed comes out and says, yeah, here's your cut. Whatever. You knew that was coming, but everything else we are going to upgrade to more growth, more inflation, and a better job market. Okay. What about rates? So the baseline here is a little bit different now. The Fed basically says, okay, the market's already priced in 3 cuts. We will endorse this. Congratulations. Even though it was very narrow, by 1 vote. Guess whose vote it was? You see this lonely dot down here?
I do.
Guess who the tiebreaker was?
Can't say.
Yeah, between 2 cuts and 3 for this year. But the market's already had it in the forecast at over 80% for both of those cuts, October and December, a week before this Fed meeting. And you can see it here. So here is, there we go. Here is October. This is a week ago. Over 80%. Here's December. A week ago. Over 80%. It's not like the markets didn't know that this was going to happen. So, what did the Fed do here? It just acknowledged what the markets already knew, but then still only 1 rate cut for next year, only 1 rate cut for the year after. That's at least 50 basis points removed from where the markets are. So this sounded hawkish. And so the dollar is up, yields are down, or bonds are down rather, yields are up, gold's down. All of those elements of what we'll come to call the Radigan, all of that is still there. I mean, you can clearly see it. Here's gold. It's down. That's not a dovish.
Gotta love the short gold, long dollar, but not satisfied with the Nasdaq's performance as it comes to the Radigan. Speaking.
Well, and this is the interesting thing. So all of the hawkishness here seems to be existing in all the assets except stocks. Stocks seem to have a very different view on all of this. So here's the dollar. It's getting stronger.
Gotta love it.
If you want to look at the dollar index, we can look at an average of the dollar. There it is. It's up.
Gotta love it.
If we wanted to look at what the bonds are doing, bonds are down. yields are up. So I can only surmise that what all of this means is that the markets have looked upon the Fed's forecasting of faster growth and faster inflation and lower unemployment and said, they have decided that they're not going to continue to try to save the White House from itself. And they're just going to say, you know what? F around and find out. You want to run this economy so hot that inflation kills consumption? Go ahead. Run it hot. See what happens. And stock markets said, okay, I guess we're going to run it hot. I guess growth is going to be faster. I guess inflation is going to be faster. I guess asset valuations on the risk side of things are going to be higher. And so NASDAQ seems to, we have it here with the naked eye, as it were. It's going up.
I find it agitating and perplexing and somewhat dismaying.
It is all of those things. What it is from a price action perspective is closing above the swing high here, and so making a higher high and basically saying, I'm resuming the trend. I'm going up, which interestingly, Thomas, is not what you have in the S&P. You try to make a new high and then you fail. Does this tell you anything, Thomas, about maybe there's something under the surface here? Maybe the market is still attempting to think about what it thinks of the Fed and still deciding? Or have we